not been looping. Okay, so mic check, making sure you guys can hear me. I think so. Okay, looks like it is coming in. All right, welcome back to Capital Mindset public live stream. We haven't done one since June, so it's been well over a month between vacation and the like. So we got a lot to catch up on. So right into it, you guys can see at the 5-minute mark, we're going to be starting on the conversation. The timestamps are in the description below. They should be guiding us throughout our presentation here today. We're going to be going over some other things that are not explicitly listed in the discussion points down at the bottom. But with that being said, we're going to be following this for the most part. We'll add some extra discussion points like TSSI, maybe towards the end after PayPal. But the first topic that we're going to be discussing is, of course, what happened with the Federal Reserve. Just this new news with one of the governors losing their job. But we're going to talk about what that might do with rates. How are people reacting to it? Is it rational the way people are reacting? So we'll get all into that. So let's see, how are we on the time? We're exactly past the 5-minute mark. All right, so let's get right into it. So President Trump came out today and fired the Fed governor, Ms. Cook. Now, what did she do? So this is very easy to get into like a political discussion, so I'll try to refrain from doing that. But the significance of this is it stoked some fears from people who've been, saying that the president wanted to do this with other members of the Fed. But in reality, I'll just cut to the chase on it. I don't really view it as much of a needle mover. And if we look at rates, what rates are doing and the reaction that we're seeing, rates are on the short end. I see some of them are moving up a little bit. And then on the longer side, besides the 30-year, I think all the way up to the 10-year, they're moving down a little bit. So really, it's tough to say exactly what's going to happen, post whatever this is. I don't really view it as, significant news, but I imagine that people all over Twitter are talking about this and spinning some stuff up. So kind of a shout out to those of you who, have been watching some of the YouTubers freak out about, or maybe more it's a Twitter thing, freak out about the Federal Reserve on Friday lowering their target. And, if they didn't bother to actually listen to the full speech. So it's nothing of the sort, while the market reacted quite positively because it showed a bit more dovishness. There's a bit, people get a little ahead of themselves and narratives tend to go a little bit further than they otherwise should. So on this channel, we've tried to focus on providing sort of like a balanced approach, a balanced viewpoint on what rates are going to do, what to do when rates do something, right? And you first have to distinguish between short end of the curve and the long end of the curve. So capital markets will be a bit less sensitive to what the Federal Reserve is going to do, and more so going to be a combination of what long-term growth expectations are and inflation expectations. And a lot of times those two things are intertwined more than what people think. So if the Federal Reserve were to lower the federal funds rate, that doesn't necessarily mean that the capital markets or the capital rates are going to also come down, or the long end of the curve will come down. So those two things can and often are separate in terms of what affects them. So it could be the case that if the FFR does come down, right, we could see that affect or impact forward growth in some way, or inflation expectations in some way. And then in that sense, it does have an effect on the longer end of the curve. And that's a separate sort of debate that people should be having. And I think there are a lot of people that are having that debate. I'm not saying it's not happening, but I'm highlighting that on Twitter, people tend to forget that part, and they just think simple terms like, if the federal funds rate comes down, then therefore all the rates come down, and that's not necessarily true. So I propose the question to all those in the audience, like if you think the rates are going to be coming down, and I left it a little bit ambiguous, unfortunately. I just realized that I should have specified the long end of the curve, and not just rates as a whole, because it's obvious the short end is going to be coming down, but what is the long end of the curve going to be doing? So when we talk about the real estate market, we're really focused on the long end of the curve. Now, for a lot of these REITs, they borrow on the sort of like the middle side of the curve. They borrow it maybe in 5-6 year increments. So when you're talking about 30-year mortgages, you're really actually more affected by the 10 and 30 year, more so the 10 year. And if you guys are wondering why the 10 year is more important to mortgage rates, it's more so to do with the average maturity of each of these mortgage loans. So it tends to be that most people don't hold the house all the way to maturity for 30 years. And so that's why it's not 100% correlated to the 30 year, but it's also not 100% correlated to the 10 year, but it is correlated, you could say, to be most precise or most correct, correlated to the long end of the curve. But you really want, if you want mortgage rates to come down, you're going to have to see those rates coming down first, the capital markets rates. And that's what's more up in the air. So who really knows? Now, if it does, there's a lot of stocks that will benefit from that, and we can go into some of them. And I have some of them listed in the thumbnail. I apologize. The description, where we're going to go into each one of them, but there's others that are not listed on there that we can also get into. I just kind of gave a brief sort of overlay on different stocks that we can talk about. Okay, is this the year of REITs? Hi, Fabio. What happened to the plans for a channel for retirement people? Thanks. All right, great question. So I'm actually in the process of transitioning jobs. So Steve, we've been pretty busy on the back side of things, but soon I will have a lot more time on my hands, and I'll be able to do more content stuff full time. And so Capital Mindset is transitioning. Well, Capital Mindset itself is staying the same, but myself, Andrew, and a few others are starting a hedge fund. So that is something that we've been working on in the backside of things for at least a couple months now, and sort of that all that's culminating into a launch here in October, November. But yeah, great question. So it's really a matter of like not had time to do that yet, and if I'm going to do it, it's gonna obviously take some time from my day. But we'll see, because you can already see that I struggle to get public stuff out, right? And I have to always focus on making sure I can provide stuff for the Capital Mindset Club members as far as content goes. And then comes the CM public, YouTube channel. And then third will be this new channel. Okay, so a good question. I know that I promised that a while ago. Oh yeah, I already answered that question. Okay, so where we are on time, because I want to make sure we're going through the right, let's say. All right, so we're at the 10-minute mark, and so we should be getting into the other one. I'm a little bit late, but it's sort of like filters in the same kind of topic. But the market reaction to rates we saw on Friday was actually really positive. So if you're invested in the markets, your portfolio was probably up a lot. Depending on what you were invested in, you were probably a bit more sensitive to that upside exposure. But for the most part, most stocks had a green day on Friday. You could have probably found a few that didn't have a good day on Friday. And today, sort of like it's kind of a pause, a quiet part. Although there were some stocks, especially those that were exposed to NIM expansion, so net interest margin expansion, those are actually doing pretty well. And I'll give you an example of what I mean by that. So keep in mind that a lot of the banks, right, they borrow on the short end, lend out on the long end. And so when you think about what's happening to interest rates, the short end of the curve is coming down, and that's reducing the cost. So a lot of these banks might be borrowing on a warehouse facility or their short-term deposits, and then they're lending out on the longer side of the curve. And so if NIMs, net interest margins, are expanding, then you're going to see that profitability start to creep up, and those stock prices are going to react to that very positively. So that whole setup has been there for a while. And then you also had there was a caller, a pitch that we did in Capital Mindset for a few of these smaller banks that we really like. Those have been reacting really positively today, and I don't think that's a coincidence. They also reacted very positively on Friday, and so that's probably going to continue for at least the foreseeable future. There's also been talks of deregulation, lightening that load up a little bit here and there. And that's been a push by Secretary Scott Bessent, right? He's talked about that a lot. And I think he was giving you basically a big signal that, you could be bullish, smaller banks, regional banks, etc. But yeah, that one's been a pretty good investment so far. Okay. The year of REITs. We'll talk about REITs in just a second if you guys want. Okay, so just making sure, coming back and make sure we don't have any extra questions. You guys can ask questions as we go. You are being played by the pros and the narrative to dump on you. Powell said long ago, higher for longer, nothing goes up in a vertical line. Last 40 chart for rates. Yeah, I'm fully aware of that, but I'm not sure what you mean by the comment though. Explain why progressive is down. So progressive is going to be something that's more in demand when you have a lot of uncertainty. The business fundamentally is doing fine. There's more of a question if they're hitting peak earnings right now. So if you look at, they've been actually taking a lot of market share from their competition for quite some time. And property and casualty, specifically in the vehicle segment, they've been growing like a monster for the past 3 years or so. They've been taking share from Allstate, even Geico, and State Farm, and a few others. And they've been growing a lot more in the property insurance business, and making a full effort to really grow in that vertical. Now, with the vehicle side, there's been a lot of concerns if they've reached this peak earnings. So I think right now the multiple expanded to about 17 times forward earnings, and then it's contracted now to about 13. So I think you just got like a little bit of a retrace there. It's rubber band back down to normalcy, and it still should be trading at a premium to something like an Allstate. Although Morgan Stanley actually made a call out to say you should sell Progressive and buy Allstate. I disagree with that because they actually do think that Progressive's growth is like basically done for. Now, if they're right, then okay, I could kind of see the case there. But I don't think that the growth rate is suddenly going to go from where it is now to basically negative, which is where it's going to have to be for the premium that exists now between Progressive and Allstate. I don't really think that for something like a Progressive, in terms of the quality that you can observe, the combined ratio and all their other metrics, expense ratio, well, it all feeds into the combined ratio, so you could just look at that honestly, and then comparing it to something like an Allstate and the consistency of it. I don't think that a premium isn't warranted. Now, should it be trading at like a 50% premium? That maybe is debatable. But whether it's now where Allstate's like, I think it was close to like 11 times, and then Progressive's like 14, 13 times forward earnings, I think that's a fair spread. And Progressive, I still think, will continue to do really well in the property casualty, specifically in the property side, and not just the auto side. I think the auto side, it's fair to say that does slow down. If it continues to grow at the previous rate, they're going to devour the whole market over the next like 5 years or so. But if they're going to probably kind of stick around there where they're at, and the growth is going to slow down just a tad bit, we could see the property really start to pick up more steam. Then we probably are not at quote unquote peak earnings for Progressive. If you look at there's charts shared by the industry that showcase the market share and the efficiency ratios of each company. We went over that in CM, and basically, if you look at Progressive in both the property, so the actual physical building insurance, and then the vehicle insurance, they're actually the top in terms of efficiency ratios for both. But in terms of market share, they're only the top in the vehicle. They're not the top, but they're towards the top. And then for the property, they're actually closer towards the middle. Now, if you think that they're going to be able to grow that market share even further as kind of time progresses, and they use their same quote unquote secret sauce that they have had in the vehicle side over to the property side, then you still got some runway there for this business. If you look at the float, they've been growing the float tremendously. So now I think they're at like 80 or so billion. They're probably gonna get to 100 billion here soon, and then over 100 billion. Now, short-term rates dropping, that is sort of a drag to them, because as they reinvest the proceeds in their float, they're gonna get lower and lower raw return on that. But they're going to, still do fine. Really, I think people miss the forest for the trees there when they focus on what investment income they're generating. And when that happens, actually, you do see the companies with worse underwriting standards do even worse and lose more market share, because what the investment income can be a shield to poor underwriting. So when you have very good underwriting, you get, of course, like the best of both, but your competitors that have worse underwriting, that maybe have a combined ratio in excess of 100, they might be doing just okay enough to get by. And the higher investment income might be helping them out get through the cycle. Okay. Thank you, Mohammed. Rate 0, tariffs 100%. Okay, so we have more clarity. U.S. is distorted to borrow short, lend long. This is for variable rates, not fixed rates. They are offering. And then Blake says the Fed wants to leave rates elevated for as long as possible to keep allowing the neutral rate to climb. So it can be as elevated as possible for next time we are needed rate cuts. I'm saying everyone thinks rates are going down. You're being played to buy longer bonds and assets that will price lower as rates rise. Just to be clear, you're saying the short end of the curve, not the long end of the curve, right? Will rise. So you're saying buy that. Yeah, I just want to clarify which one you're talking about. Good, Fabi, reading the chat. This was, what do you mean a rare 10 out of 10? Okay, so I mean, we could probably make like a very friendly bet. Is your name, are you Hans by chance? Do you change your name, Hans, to Captain Happy Pants? Let me know if that's you, Hans. I'm see, if not, you're very similar to Hans. You speak like him. I've gotten to know a lot of you over the years that we've been streaming. Okay. See, I could tell it was you. See, I see, you guys aren't just like names on the screen. I read all your comments, so I get to know how each person talks. Like, I know if Fuhad changed his name, I would know it's Fuhad for sure. Some of you could probably get me. No. I think one of my mods might have muted Gil because I haven't seen him in a long time. But the content does, or the comment section tends to be more direct to the topic. All right, let me check if we are on the time. Okay, we're still good. We're not going to talk about United Health for another 3 minutes. Okay, so won't the fund ultimately potentially destroy the CM content and vibe? Okay, so there are things that we do need to be careful about. And as long as I'm acting within those parameters, it will be fine. I'm going to act within the parameters that are both legal and moral. So I'm going to look at each, piece of content that I, dish out and think of it passes both of those. So yeah, it won't, there will be not like, anything goes sort of vibe, but that doesn't mean that we can't still produce content. We have a few friends of the channel that had hedge funds and still made content here on YouTube, and it's perfectly fine. And we currently have one friend of the channel that we brought him on for a live stream. We had a whole discussion about a particular stock, and it's perfectly fine. It doesn't mean that you can't talk about particular stocks. And the entity structure that we have, we're able to actually talk about the fund publicly. It's not something that we can't disclose, or we can't talk about, because there's two types of structures that you can form, and one of them just means that we're going to be a lot more strict on who we let invest via, making extra sure that they're accredited. But yeah, like it shouldn't really destroy, in my opinion, the vibe. I don't have the intro links. It's somewhere, but I got to find it. I don't have it offhand. Gil doesn't need a disguise. Mods equal Dan. I will confirm nor deny that. Gil doesn't need this. So the shirt needs to be a mainstay, to be honest. Thus for 10 out of 10. Oh, I forgot. Fuhat's grinder rating me. Okay. Thank you, Fuhat. I'll take that comment. So you like me in white shirts? Good to know. Fuhat likes me wearing white shirts. I do as the people please. I wear the clothing you want as I talk to you. Okay, before we get to United Health, I have a couple seconds to talk about this. The glass is 8.7 out of 10. The change in logo for Cracker Barrel. Okay, so I just view it as this company, it was a dying brand or a struggling brand, and they were desperate to do something. They needed to do some change. So the CEO, she did something radical. She got rid of the old man. I saw funny memes about, the Aunt Jemima, the Land of Lakes, and they were like, "Oh, welcome to the Cracker Barrel logo." I thought that was pretty funny, but yeah, no, it's not really a location that I would go to. I think the quality has just gone downhill for a long time now. And what they've basically been doing is, since they were the value proposition, they've tried to keep the prices more or less the same. And then in order to keep those prices the same, they have to sacrifice quality consistently. And so you just got a worse and worse product over time. So this logo change, I think, is, well, if you just listen to the CEO, what she says, it's like, oh, to appeal to a different audience, blah, 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 because, they're desperate. I think it's a point of desperation. I have no interest in investing in Cracker Barrel. And didn't think they were a good investment before. Don't think they're a good investment now. So, okay. We're talking about PayPal. Look in the description. We're talking about PayPal, but later. So in the description, it should, that's how I keep things organized. So it should be there. We're going to talk about United Health right now. Okay. I know Andrew is uber bullish. Dave, I haven't seen you talk about it specifically. What's your stance on today's price? I like it. You can check out, we did a video here on Capital Mindset. We posted it here. You can, let me go ahead and get that for you. So you can check out the title. Okay. Let me do content. If I go to videos, this one. Okay. So let me share my screen. Where did I put you guys? All right, you guys over here. Oh, the devil. And he now, wait, I got to put on my headsets. I have someone. Wait, did I bring you? Wait, hold on.
No,
I can hear you because it's loud enough.
Okay, I just want to talk before you had your headset on. No, you didn't invite me, but life finds a way.
Well, you have a key. It's implied. You don't need an invite.
I know. So what are we talking about?
Well, we're going to talk about United Health right now, but I'm going to share the video so the person can go see, because we both talk about it here, but they were asking if I think Dave is a good buy here. And I said, yes, to be direct. So no, but this one. So you can check out this video. The title's there. Dave Stock, your financial friend to your returns, very specific. So if you check out that video, you'll hear both of us discuss it. It was posted 2 months ago, June 25th, 2025. So anyways, those are our public stances on Dave, but we both think, yeah, say Dave 3 times and Andrew will appear. We did do that. So,
well, I don't even know if you're asking our opinion about Dave. I guess you don't follow us that closely. I don't.
No, well, it's a new viewer.
Okay.
Hey, he's a new viewer. He saw you on Chit Chat Money.
Gotcha. Okay.
Yeah,
that makes sense.
Oh, we're on the public side. We're on the private side. This is a public stream.
Oh, true.
So anyone could, hop in here. All right. So we got some more questions, but anyways, we got to get to the topic. Otherwise I won't get into the topic, and so let's get into United Health. And people who are like fanboys of a particular company, you're going to be so mad at me right now. And it'll make sense in just a second.
What? Oh,
I'm not using Google Finance.
Yeah.
Anyways, so I'm not using Google Finance at this moment. So United Health, let's talk about it. So this rally that we've seen, this rally, look at what it looks like. So this company's still in the dumps, all
This
things
is the
considered.
like the
Yeah.
oh.
Oh, let me zoom in because I forget. Different resolution, 1080p streaming versus 1440p screen. It fucks it up. But anyways, so I got to zoom in where it's like ridiculous for me and then where it's like normal to you guys. Okay. Yeah, that looks ridiculous to me, but I guess it looks normal for everyone else. You would never, use a screen this zoomed in. Well, anyways, whatever. So United Health sitting at $304. I did a video on United Health. United Health is a decent size of the portfolio now. I wanted to make it larger, and I was actually hoping that we would get to 220 and then maybe get close to 200, and then it would have made it to like a varsity size position in the portfolio. But I'll give you the elevator pitch for anyone who's listening. Is like, okay, what the hell? United Health is a complicated conglomerate. I actually don't think it's as complicated as people make it out to be. I respect that at the surface it does look fairly complicated. There's 3 business lines you really have to dissect. In Optum, there's basically 2 that you have to worry about. One of them, let's separate and say they have this wonderful business, Optum Analytics. It's a software and analytics business inside of it, or Optum Insights. I apologize, Optum Insights. And you got 18% operating margins with a $30 billion plus backlog. So there's a lot of actually potential just in that business right there. And I don't like to do some of the parts, but if you did, you would get something that's much larger than today's price. Just kind of throwing some whatever multiple you want on Optum Insights, and you'll kind of see where I'm getting that. And then you have the actual care side of the business in Optum that provides, you can think of like your clinics, et cetera, your doctor networks and the like. And then you have the insurance side of the business. So everyone thinks of United as, just this insurance company, but there's so much more than that. And there's a lot to really get into because I don't even know where to start. But let's basically talk about the fraud allegations, they say. So the fraud allegations are interesting, but I think that they're going to come out mostly nothing burgers. Even some of the accusations, when you actually ask some of the physicians in the Capital Mindset Club, and some of the physicians I asked outside, they were kind of like, this is kind of, this isn't really fraud. This is more like normal. This is the standard practice. And it's not someone will say, oh, so the standard practice is fraud. No, that's not what that means. Well, so these have to, go.
I mean, to kind of flesh out that point a little bit, because I think it's like difficult for people to understand, right? So let's say I go to the emergency room and I say I have stomach pain, right? Mm-hmm. And you're a doctor and you're looking at me and you're going, oh shit, like, is this, I shouldn't say, oh shoot, is this, there could be so many things. He's got stomach pain, he's got this symptom, it could be this, it could be that, whatever. So you admit him and you put him under like observation, right? And it turns out that he just had like a really, really bad stomach ache and needed some Tums, right? Or something like that. And so, but it was like really, really bad, super painful. And you as a doctor, the healthcare provider, you didn't even know what it is. So then you go, you end up billing and you bill to insurance. And the insurance company goes, whoa. You think we're going to pay for his tummy ache? Like, I'm not paying for this guy's tummy ache to this multiple $1,000 bill. No, denied. And then it goes into all this back and forth. So I think it's just like understanding the structure of how that works in the back and forth. I think that's more what it is my understanding.
Yeah. And I mean, we spent, I think it was like a 3-hour conversation between a healthcare provider and people on the insurance side. And just like the magnitude of that, it was 3 hours or maybe close to 4 hours of discussion just on this topic. And then outside of this, I've been talking to different people in the provider side, different people in the administration side. And it's really complicated. You really have to, there's a lot of legwork involved to just try to understand how the system works. And I get that. Now, where it's kind of simple, quote unquote, is after you get past that understanding, I think the business itself isn't, too scary or terrifying. And Andrew, you joked, I remember in the club, you basically posted a very long message, but it's basically the same thing repeating itself. It's hard market, soft market, hard market, soft market, hard market, soft market, hard market, soft market. Yeah. And every insurance business goes through a different cycle. And in effect, the health insurance space is going through a tough time, but the tough time creates the nice time. And in their case, they actually lowered, or they had a really low price increase period from the past 5 years. So they grew prices anywhere from 3 to I think 4 or 5% when they should have been growing them at 8 to 9%, or I think it's 7 to 9%. I think it's a bit wider range. So that's what they should have been increasing the prices, but they didn't. And that's what got them into this predicament. So I want to actually make, somewhat of a very obvious prediction, but the prediction will kind of jab at journalists a little bit because we have to do that. So this time next year, or maybe a little bit earlier, you're going to hear on the news, and they're going to get it wrong as to why, but they're going to blame something else. I almost guarantee you this. So just actually remember what I'm saying here, because it's a fun prediction, but I'm pretty confident it's going to happen. So when they increase the prices next year, the journalists, you'll see it all over the news, are going to report it, but they're not going to get the reason why it's going up correct. They're going to say another reason. I don't know what that reason is going to be, but it's not going to be the right reason. So in the real reason is because they're doing a catch up. They need to increase the prices to where the cost of healthcare has gone up to match it. So it has to be a big increase all at once, or at least 2 years of decently sized increases to match the difference that what they actually increased it by versus what the costs increased by. And again, like I just stated, they increased the prices by somewhere between 4 to 5% on average. And then what they should have been increasing on average was 7 to 9%. So next year, we saw what some of the proposals were for some of the plans. And United Health was actually on the lower end. It was, I think, Oscar and United Health on the lower end of the increases. United Health was already on the lower side of in terms of cost per coverage. But some of the other ones are increasing it some close to 30% request. And the solution, you can kind of look at Aetna as like the example of what will happen. So the way to fix it is you increase prices and you churn your portfolio. You reduce the amount of policies that are unprofitable. Now, some people don't understand that this is good. They look at revenue figure go down and think bad, but that's not the case, right? When we invest in businesses, we care about profits. We don't care about sales. And when you're reducing the certain policies because they're not profitable anymore, they don't make any sense, then that's actually good for the overall business. Now, what did United Health do that was bad? This is a point of criticism. So the prior management team, they did the meme, I can fix her, right? What do I mean by that? Well, Aetna left certain markets, and then United Health came in and tried to fill in the gap. They tried to insure certain people under certain prices that did not make sense, to the point Aetna actually pulled out of those markets. The management team was like, oh, I can fix her. I can make it work. No, it's not that easy. And insurance is like a game of hot potato. So just because if you pull out of a market and your competition goes harder into that market, but you determine that market is untenable, then you're winning double fold. One, you're increasing the overall profitability of your network. And two, you gave your competitor unprofitable policies, which will make them less competitive in the remainder of the region. And a company that went through this was Progressive. So when Progressive decided to exit California early, the other competitors took market share. What happened? Well, Progressive was right, and that enabled them to take market share in the more attractive markets. Their competition took market share in California, of course, because Progressive left, and they were left with the hot potato. They burned their hands. So when they burnt their hands, then Progressive is actually able to maintain, if not compete more on price in the more attractive markets. And then the company that made that mistake is unable to do so because they're in a weaker position than before. So that's the gist of it. Now, another fortunate thing about UNH is that it's, I guess, gotten a following of special people.
Well, I just want to say we're saying this about UNH right now, and I just want to point out something because this isn't like us at all responding to sentiment or anything. I sent you I sent you 2 DMs. Look at the times, and you and I were in complete alignment on this. Look at the date on that.
Yeah, let me pull them up. This is the second one. I'll pull up the first one.
Yeah, to be clear, July 29th, it was at 260. This is like everyone's freaking out. UNH is going to 0. And to be clear, Fab and I were just agreeing here on this.
And this is the long message I was referring to.
Yeah. And so, I mean, that's all this is. And my only thing with UNH, though, the other thing I have is on the flip side, you have people saying that it's the next meta, which is like very cringe and not at all accurate in my opinion.
No, this is the example I'd probably provide is this is like ExxonMobil back in 2020.
That is such a good example.
Yeah. So what happened in 2020? I don't know if all of you guys were investing back then, but a lot of people are like, don't invest in oil. Oil is dead. That was the prevailing narrative. And right now, or maybe just like a month ago, funny how people change their minds so quickly. Or maybe people are still saying that, but I think they're just wrong if they think that. Healthcare, health insurance is uninvestable. And if you look at the space, they're all destroyed. These companies can't make a profit, et cetera. They're in a troubled industry, lots of regulation, the government's going to come after them, yada, yada, yada. And then that's typically the time when there's something to hunt for. And I will say this, like there will be insurance stocks that return better than United Health. There's actually a few that I may or may not get involved in here soon, but because unfortunately United got out of its like sweet spot for me, and I already have I have a satisfactory amount if it were to run from here, but some of the other players still haven't ran, and some are I think better positioned than others. The space itself is not what is depicted, in my opinion, as this super unattractive investment. I just view it as like similar with oil. That was the time to pick up oil while everyone else was making up bullshit. And I think right now people are making up bullshit on healthcare insurance, and it's been a decent time to accumulate.
People make up BS on everything. I mean,
Everything.
People made up BS on Powell's speech saying that the Fed is now like we're a third world, basically a third world Fed, without actually reading. All they did was take like a Bloomberg bullet point and then make a whole conclusion. It's a 20-minute speech and they took one sentence out of it. That's what people do nowadays.
Yeah. Yep. Let me check how we are on the time specifically, but we are we're perfect. I gave us enough time to fully flesh this out. Like I recall the same thing happened, like Netflix, Amazon had 2 different bullshit narratives this year. Like just this year alone, I recall Amazon having 2 of them. And they like sort of changed because one of them was proven false, and then the other one just like was born because the first one was bullshit. It's kind of funny, and so that's something we like to joke about. We see it often, or too often, that the price drives the narrative and not the other way around. So
Price drives narrative always.
yeah, we see it a lot. I started actually
But
Mhm.
even on the infamous buy side. That's why I always make the joke like I'm buy side. I'm buy side. I can never be wrong because I'm buy side. And but they're just as bad.
Yeah, yeah. If you go on Twitter, it's and you see the other, I guess, analysts, professional analysts, or professional money managers. They let the same thing take over for them as well. They let the price drive the narrative, and they don't let the let's say they don't look past that. They get sucked into the exact same game as everyone else.
Oh yeah.
Okay. Now let me see if there's any questions on this. Okay, I see someone's. Okay. Oh, let's not forget about what Buffett did, right? So Buffett buys, and I'm like, I don't give a crap about Buffett buying this. He bought like a tiny amount, and there was a few others. Okay, I wouldn't care about Burry. Like Burry's portfolio is gonna be entirely different next quarter, but there were a few others that made purchases too. In fact, one of them, I think it was Tepper, made it 11% of his portfolio. And it's like that's more of a statement than what Buffett did.
So just because people were like, oh, I see Buffett doing this. This is like such a what they say vindication. I think it was. So if I recall correctly, the amount that Buffett purchased, okay, let's say you have a $100,000 portfolio. It was a $600 buy.
Mhm.
That's what he did.
Yeah. Well, to be clear, we actually don't know if he bought more because he could have because
but
those purchases were like you see my mouse like here-ish.
right.
So we don't know if he bought here.
We don't know, but the point is like neither of the people that were freaking out about it. It's like, I mean, dude, if I take a teaser position in a stock, it doesn't mean anything.
Yeah. So like, I don't want to. No, I just don't want to like shout that they are so dumb and wrong. They're wrong for. If they're right for the wrong reasons. That's what I want to say. So, because they don't make that argument. They'll usually just say he bought vindicated, but they don't go further and say, okay, he may have bought more down here. They don't really get into that. Most of the people I saw discussing this. So if he ends up, we see in the next 13F that he accumulated a lot more, I wouldn't go back and say like, oh yeah, these people knew the whole time, right? But it's it did provide. I don't want to like say it didn't matter for the stock price. It obviously probably had an impact because you probably hit like a big flush down and you were at near peak pessimism. I guess you could say we were at peak pessimism because there was a lot of nasty narratives coming out. And I mean, at this point, it's a joke when you get the Wall Street Journal articles on you. Yeah, that's a wonderful organization. I think I remember when Meta was at its lowest point. they did some stuff as well. But yeah. Okay. Let me check comments real quick. And then we have 2 minutes left on UNH.
Oh, you have this like timed?
Yeah, it's all in the I have the timestamps down below. I can explain a bit on this actually.
A bit on what?
I guess on United Health.
Oh.
This is blown on the streets play. Say Buffett bought before it went down more. He's washed. I don't even think it was him. It was for the size. I think it was either Todd or Ted. He seems to be more selling than anything. Like he sold more Apple. He sold more Bank of America. Like the big stuff he's selling.
Well, I just sent off an email.
Which email?
Just about the legal entity.
Oh, okay, that email.
Yeah.
I could tell you were multitasking.
Yeah. I just want to make sure I got that out. To
All
be
right.
honest, I didn't hear half what you were saying about UNH, but that was important. I had to get that out. So,
Well, I'm excited to be more like on the quote retired side, not really retired, transition side. I can do more content. I have fun doing live
well,
stream.
you better do something else first. You better make returns.
Make-
gains.
Make returns first, 24/7. Oh,
No fun.
I'm looking at we have the next topic. All right, I think the next topic we have is FICO. You love FICO.
That's my favorite stock in the world.
By the way, if there's any questions on UNH or comments on UNH, we can go back to it. We don't have to stick solely to FICO, even though we're on the FICO topic. Probably transitioning so brave. All right, let's get so FICO is one that might react more if capital rates come down, but that has everything to do with like the volume expansion. So FICO, I'll give a brief introduction. If you don't know, they're behind the FICO score. For international investors, this might be like, well, what is that? So well, they're expanding their presence internationally slowly, but the main presence they have is in the United States. And they have a couple different segments. They have the software segment and then the scoring segment. The scoring segment is by far and away the most important. The software segment is less so. But although, could become something in the future for all we know. So it doesn't really need any incremental investment or reinvestment. So it's a business that can be pretty capital light and return everything to shareholders. And then the growth profile can just come from the volume expansion plus the price increases. The prices for each score pool is about $5. So when you pull like the tri score, it's going to be about $15. When you take into account the entire cost to close the property, it's a tiny fraction of the cost. And then you have Polte, who's a very intelligent, wonderful politician.
He's my hero for real.
He's my hero. Yeah, he's my hero as well. He's really looking out for the home buyer because he's really trying to tackle what's really causing prices to go up, and that's of course the $15 cost the FICO charges. And so he's trying to sort of push in or make a lot of noise about the Vantage score, which has existed for quite some time. And FICO has the new 10T score that still hasn't been pushed by the regulators for housing, even though there's some indication that's far superior. And right now, the current FICO score that's used by the loans that will then be held by Fannie Mae and Freddie Mac are not using the new scoring system; they're using the older one. But even then, you can see that there's a strong resistance to use the Vantage score because of the infrastructure that's been built around the FICO score system. So this is sort of like the language by which banks speak to one another. It's similar to the moat that you see and observe with a Moody's and S&P Global. When you go to get your credit score rating, you could, as a business, elicit the help of a Morningstar, or someone else who's not as expensive as a Moody's. Will that help you? No, you'll be shooting yourself in the foot. It's better to pay up for a Moody's rating or an S&P Global rating than it is to look at what you're going to get by paying for something like a Morningstar. And if you do so, right, if you choose to go for the cheaper option, you'll pay up for more of it in the actual cost to borrow. You'll see that your interest rate will be a lot higher, and so the interest rate that you'll or the interest expense that you'll pay will be more than what you saved in just paying for the more official credit scoring system. So it doesn't even matter that it might be better or more accurate. There's also, believe it or not, a branding power. It has to come down to the language of banking, how institutions read certain things. So there's a lot of infrastructure built on the FICO system. And I was tweeting at Polte, even though obviously he's not going to respond to me because I wish he did. It would be hilarious to go back and forth with him. But he's really, if he does something like what he's planning on doing, and if he actually were to accomplish it, he could actually do more harm than good. I don't exactly know why he's engaging in that other than just making noise. And so that's my conclusion. It's a bunch of noise. And FICO in the title, or I think the discussion we're having about it is like, is it expensive? I think the quick and dirty answer is yes. How do you know? Well, it has a, let's look, it has a high PE. It has a PE of 55. And so on the surface, it's not a not a cheap stock. So, let me check comments real quick before we go.
The peers that lists here are very interesting. Tyler Technology, it's Perplexity has some work to do here on peers. I don't know how you could say Paycom, Tyler, Wex, and Roper are peers to FICO, but
okay, Chris is saying some things here. No, I agree. So like what I talked about in my pitch about UNH is like either MLR is at 90% or so. So if they get their MLR back to about 81 from where it was before, then yeah, right there you have that earnings return to where, well, actually it will surpass, because you'll still probably have some top line growth through premium price increases. And I think the MLR is going to get there probably to 85 easily by next year. And people are underestimating how quickly it's going to happen. So yeah, we're in total agreement there. I disagree on maybe the time that it'll get there. So you say will take time. Well, it depends on what you say will take time, because if you say will take time is like a year, yeah. But if will take time is 5 years, I think 85 is very doable by next year, because 80% of their policies will be repriced by January of 2026. And so with that repricing, you're probably going to get some more of a match to the cost than there is now. Oh, you have 2 years. No, I'm a bit more optimistic than you. I think in 2 years, easily. I mean, if that's what the market's pricing in, then there's probably even more upside.
I don't think the actual return profile on this is very interesting. I think the more interesting thing about UNH is the fact that, in my opinion, it's going to be an uncorrelated return.
Mm-hmm.
And I don't
like
think yeah.
Like it's not 100. You don't think it's like 100% in the next year?
No, but if you can confidently underrate like a 30%, 35% over the the next 2 years, and in my opinion, it's going to be irrelevant what the market does. Market go down 50%.
Yeah.
Well, maybe in that case you might not go up, but if it went down 50%, but you know what I'm saying? Like it's going to be relatively uncorrelated to the market, and that's what I think makes it interesting more than anything.
Yeah.
I don't, because a lot of people don't think about that. A lot of people are just looking at like a total return profile rather than looking at, what's the market beta, what's the correlation to the market, and that's where I think UNH becomes very interesting as well. Yeah, just like that whole space right now. There's certain spaces. Actually, there's another one which I don't would still be. That's why there's some industries that have just gotten obliterated. This healthcare being one. I think the other one I started digging into is software. The issue with software is like these companies make billions and billions of dollars, but can't turn a profit on like supposed high margin industries. But that's a whole nother discussion. But no, I think UNH is interesting. It's the healthcare is a little out of my circle personally, but I don't think these are super hard to underwrite, and I think the correlation to the market is very low.
And Fuhat's making me want to talk about it again. I already talked about it, Fuhat, but to highlight it once more, yes, they do have this potentially underrated tech business built inside the business. I don't think it's that underrated, because that's in basically the implied premium that UNH trades at to its peer group. It has a much larger, more robust, more developed tech platform built inside of it that has 18% operating margins. So with a pretty nice backlog, all things considered. So 30 billion, I think. 30
company margin, operating margins, or what? Two.
Yeah, because you're including the insurance. But if you look at the insurance revenue, it's like, so the analytics and software business account for, I think, like 20 or so billion per year
Mm-hmm.
run rate. And then the insurance business is well over 200 billion.
Yeah.
So that draws that down quite a bit.
Sure. I was just thinking about how much that bumps up the margin profile if you can grow that at a decent CAGR. It's not going to do much for a while, but
No. But it's not that the insurance side is a bad business. It's more, that's the utility side. So they have the utility side of the business. Then they have this other side where, you know, the profit margins are more uncapped. Well, they have all of Optum. So Optum RX, Optum Insight, and Optum Care. So all of those are more so uncapped, with the limitations that Optum Care and RX do operate within. But the one that's generally,
so
you know.
Fun fact, by the way, you just mentioned utilities, and I found out that someone who I know pretty well. I didn't know what they did for work. I know them through church, and I was asking them what they do for work, and I'm not going to say where. They do statewide energy planning, utility plan, energy utility planning, and it's very interesting. Probably gonna have a lot more interesting conversations with them in the future. But we had a pretty interesting conversation today. The short end of it, I'll just say, is all of these states are completely, like, before they would say, here's how much will come from like LNG, here's how much will come from solar, here's how much will come from wind. All the states are just backing out solar and wind. Like nothing will come from them in the future.
Wow.
So
unpredictable.
Yeah.
All right. Back to FICO. But again, anyone adds comments on and the payments business? Yes. Can you explain the mode of FICO? Switching costs and scale. Companies will always pay up for quality. At what point would companies move to a competitor? So the cost would have to be so prohibitive to make it worth their while. So I'll give you an example of a bank that uses.
The simple question is, you know what a FICO score is?
Yes.
What else is there?
Vantage score.
Yeah. Okay. Vantage. Who uses Vantage score? Like if you went to 20 Americans, if you went to 20 Americans, 100 Americans, you ask them, do you know what a FICO score is? 100% will know what that is.
A company I pitched not too long ago uses Vantage score only.
And I know. But if you went to 100 Americans and you said, do you know Vantage score? How many would say yes?
Very few.
How many even know how to track it?
Even fewer.
Yeah.
For example, most of the commonly used apps, Intuit, which is also down, has Credit Karma. The one I think you see the most readily available. Your American Express app will give you FICO. All your bank apps will give you FICO score. I think actually Credit Karma just gives you each of the three. They probably also give you the FICO score in there. But anyways, I haven't been on there in a while. Chase Bank uses Vantage score. I haven't logged into my Chase app in like forever. I thought it gave us FICO score. I know Bank of America gives you the FICO score. But Synchrony Bank, they actually utilize FICO score. But if you look at what Synchrony does, they don't package their loans and sell them off, really. They sort of just want to keep all the loans that they underwrite. That's what they're really doing. They're not like churning. Synchrony.
Oh, Synchrony. Oh, right.
Yeah. So Synchrony is one of the banks, consumer banks that went full just like Vantage only. And for them, it makes sense. But like if you're a bank that's going to go and try to sell these loans to someone else and you're using Vantage instead of FICO and you're advertising the package of all these loans as Vantage score, you're going to get a discount on that. And it's probably not worth the savings that you would have gotten by paying for Vantage than just paying for FICO, which again isn't that high of a cost.
The other thing that's very good about the FICO score, that's like, I think for for what it is, the FICO is a very good system. Like, yeah, I complain about missing a payment or something. It's not going to be always accurate on each individual. But when you bucket people together, a 650 FICO customer, you kind of know what they are. 700 at FICO customer, you know what they are. 500 FICO customer, you know, like it's, you know.
Yeah. It's a common language. It's a lingua franca of finance.
Right. I know what that means now.
Yep. You know what that means?
You explained it to me.
Oh, yeah. All right. So a part of FICO's moat won't be eroded from competition because people like to compare scores from different sources.
So to be clear, Marcel, TransUnion is one of the feeders into a FICO score. That's all it is.
Where's Marcel? Oh, here. Yeah. TransUnion is one of the credit bureaus.
Right.
So FICO is not a credit bureau. They're simply an amalgamation by which all of the credit bureaus feed into it, and then you get spit out a FICO score. So FICO will take all of the data from all the credit bureaus and then provide the lender a FICO score. Yep. I earlier said that it costs $15 for the tri pool. So when they get all three pooled, it's $5 per. Yeah.
Nothing other than like maybe Pulte yelling at them again, but which is why it doesn't make any sense to yell at them when, like, if you're doing a $400,000 purchase, $15 is like, it's not even a rounding error, I don't think, technically.
No. So if Pulte really wanted to go after the cost of housing and cut down the closing costs, I know that some of my audience is like realtors, but technically the realtor fee is one thing to go after. If the government wanted to I don't think they should, but if they really wanted to, actually move the needle, realtor, mortgage, MLOs, what else? Those are the two major ones, because like you have the realtor will get at 3 and 3 on like a normal standard. Oftentimes it's negotiated for lower on one of the parties, but you got 6 right there. The MLO 2, another 2%. So for closing costs, it's already quite a drastic amount, especially since it's calculated as a percentage of the transaction, while the FICO score pool is going to be a fixed cost. So it makes it even worse when you consider that. But Pulte's not really talking about that. So, he's kind of a clown. But yeah. This is a good question. But you go.
Well, to answer that question, it probably goes to like a staple multiple, my guess.
Yeah, like easily in the 20s. Easily.
Mid to high 20s. Yeah, like what is Procter & Gamble right now? 28?
Yeah. I mean, like I said, there has to be some drastic change for me to think otherwise. But this company is one of the companies that almost like chooses how much money to make via the price increases. Like the price increase is the main driver. If you get a volume pickup plus the price increase, oh boy, like that PE that's at 55 very quickly can get down to, something closer to like low 30s, 20s.
What do you think of the potential of a lot of these companies, like a certain tech startup or just larger, maybe banks even, can start to use their own internal AI underwriting to replace the FICO score?
Literally calling out Upstart and the like. So yeah, there's potential for it, but do they want to sell these loans or do they want to keep them on the books? That's the difference.
Well, in Upstart and SoFi and like, I guess like Pagaya, they all will sell the loans, but I'm assuming that they still need some kind of, like, if you're selling a loan that you wrote to another bank, they're going to want to know, oh, like what tranche are these? What kind of FICO scores are these? So I feel like at some point you still have to pull that.
I just quickly checked. It says here that Upstart does use FICO.
They have to, because you're selling the loan.
Exactly.
Yeah. But
so then there you go.
I'm saying no, but I'm saying what if JP Morgan says, hey, we developed an internal or Wells Fargo. I'm trying to think. Wells Fargo used to be the big mortgage bank. I don't think it is anymore. But let's say they said, hey, we developed an internal product that we're just going to ditch the FICO score and instead use our internal product. We've been testing this. Now to be fair, you'd probably have to test this for a while because how long do you test until someone defaults in their home?
Yep.
So you have to test it for a while, but then you say, hey, we've been testing this and we're going to start, maybe you don't put all, you're going to start putting 5% of our mortgages on this. I mean, that could end up being a long-term tailwind because then 5% can become 10%, can become 15%, as you monitor it in the tranches, are the same and you get to save the money. Now, back to your original point. How incentivized would they even be to worry about this because it's just a small expense? So it's like one of those things where,
well, not only guys, it's not only that you don't even pay that expense. That's the best part.
Right.
You don't even pay it.
You pass it
as
on.
the bank. You don't pay that. You charge
Right.
that to the customer.
So you could argue that you'd make a markup, but like either way, it seems very low to me because there's so many other things to focus on automating before you get there.
So do you know, like, the reason why Synchrony did it is think about the loans that Synchrony is doing. So if it's a car loan, it makes no freaking sense.
Also, dude, I worked at one of these banks. They are very slow to update technology. My goodness.
They're not going to change.
Bro, I'm using, like, you would log in and like literally there was this one report I had to pull. And I'm not going to get like too into the weeds, but basically for the report to work, I had to use the 97 version of Excel because that's the only version that would work with the report. So like we had this whole process where it was like log into this like random, we had to like remote into this random like computer that we had that we wouldn't update because it had the 97 version of Excel. And that's the only way. You have to export it back out. That's where the systems were at. So
okay, so everyone's favorite personal loan lender that did change the business model and actually looks a lot better now. SoFi.
Say that
again. I'm SoFi. I'm just getting into the topic of SoFi with FICO. SoFi, notice what on their presentations they always highlight.
Is it the FICO score?
Yeah, they highlight the average FICO score. So because I'm just highlighting more so for people to understand how it's the lingua franca. They're communicating to people, and people like Blue Owl or entities like Blue Owl who they now offload a lot of their personal loans to, which is actually great for them. For SoFi, not Blue Owl.
It could be good for Blue Owl, but
could be.
I think Blue Owl is very degen, so their underwriting, that pick rate they have is pretty crazy. So
yeah, exactly. But yeah, so like SoFi is paying for a tiny amount relative to the cost of the loans that they're generating, in the tens of thousands, if not over 100,000 in loans, and they're able to communicate to a willing buyer, Blue Owl, hey, here's what the average FICO score of this pile of money looks like. You want it? Blue Owl's like, yes, give it to me. So if they were to change that up and then do something sort of like internally, there's a question mark as to what they're going to get. And same thing with Upstart, because Upstart uses it. Everyone really uses it. Synchrony, who does it, first of all, for smaller stuff. So you guys might have, experience with Synchrony Bank. Like, oh, I bought a mattress. I think they do the mattress card stuff. Oh, I bought a mattress. It's $2,000, $1,000, or you're a baller, $7,000 mattress. Or I don't know, they even go higher than that, $12,000 mattress. But for the most part, people are, I think, what's the average price people pay for a mattress? It's not 12,000, right? It's like
no.
2,000, 3,000.
Yeah. Well, 1, yeah, somewhere between 1,000 and 4,000 probably.
Somewhere between that. So smaller loan. Maybe start making the argument, maybe that, they're going to start doing something.
You're reminding me of I had a friend who worked at a furniture retailer, and they'd always tell me that So there was two types of loans you get. The Synchrony loan was the one if you had like a decent credit score.
Oh, it gets worse than that?
Oh yeah. And he goes, then there's like these people. He goes, dude, the way he described them. My friend is like a comedian. He's like, I'd see these people walking in. They might have like two kids with them. They just kind of had like this lazy look in their eyes. Their mouth are just hanging open. And they had like maybe some drool coming out. He's like, and it'd be like they didn't qualify for Synchrony. And so we had this thing. It was called like first advantage or like some kind of name. He's like, dude, I did the math once. For a $400 chair, they paid like $3,000, and they wouldn't care. They'd just be like, okay, like sign off.
It's like Credit Acceptance Corp.
Yeah.
Which this one, I need to find out. Do they use FICO score? But this thing is literally that.
Dude.
It's like, oh, buy a car and then you're paying like $3,000 a month.
I think based on the comments, I feel like our guesses on the mattress costs were very off. Because people are like, how much does a gallon of milk cost? How much is a banana? $10.
I don't know.
Oh no, I'm seeing mattresses for like $400.
I actually don't know how much, but because I don't. I think. Well, actually, no. Hold on. I actually just bought. So I know. Okay, the Fairlife one is like $7 is my
For what?
gallon of milk. Oh wait. No. My math is off. So because
I feel like it's like
5.
Is that expensive where you're at?
6.
Really? I want to say near me it's like $3.
Yeah, but I'm gonna go with 5 because
it's like $3 near me.
$3 for a gallon. But wait, what brand? Does it matter? Store brand? I think it's store brand. Maybe it gets 4. All right, so but we're having my mattress is $900. So maybe we were a bit off on the mattress estimate.
That's how people are making fun of us. They're like, I don't know, like $4,000. We're like buying like the pinky finger in the air type.
I will say a purple mattress is worth it. Depending on, actually, no, that depends on the person.
They're weird.
I like the one I got because they have different versions, and the cheaper ones are more firm if you like that. But
Doc's comment. To be clear, I haven't bought a single thing, like a single grocery thing, since I've gotten, well, actually before I was even married. Like ever since we were engaged. She had my Walmart login, just like boom, she placed it in. Okay, go pick up your order. Thanks, honey.
Yeah, I mean that's the thing. Like, I don't know, especially if it gets lost in the basket, right? You just pay the full grocery bill. I don't itemize things like that. But anyways, getting too much in the.
I know how much we spend at Walmart every week. Yeah, but okay. Anyways, back to.
All right, we are on to. We're gonna get onto Salesforce here soon, and then PayPal because people are asking about PayPal already. Don't worry, we're gonna get into that. So on FICO, last bit with FICO, the whole point of that conversation is to just discuss or bring up hedge funds. Partner says women should buy all of. Yeah, where it is. We got to practice.
We're getting cooked here, man.
Okay, so fair FICO, is it decent buy? Like I think it's going to surprise people. Very likely, it's going to surprise people. You get volume pickup, price increase, done. That's all she wrote. That's the game. Mm-hmm. Okay, let's get into the next topic or start prepping people for the next topic, and that's going to be Salesforce and why SaaS is weak. So Andrew, we've been talking about this for a bit.
Yes.
All these fucking SaaS companies and they have these like 90% gross margins, and they can't make any money.
Okay. This is when I started going through them, the only way I am rejecting the GAAP method of gross margin calculation for these companies.
Okay, this guy. Okay.
I am saying you have to include R&D as a cost of goods sold. And then you see the true gross margin. So think of a company.
I love picking on these guys. Team Atlassian.
Oh, Atlassian.
Yeah, Atlassian.
How much I would love to own Jira. Hold on. Dude, my dog is on one tonight. Take your ball and go lay down. You see me constantly looking over it because my dog keeps on dropping a ball there. I'm like, dude, go lay down.
All right, let me get the.
I'm pulling up their financials. Yeah. Okay.
I'm already.
So you already had me.
Yeah, you want growth margins, just to make fun of them.
Yes. What is their growth? Okay. So
82.
This is the gross. Okay. Well, how much? So I guess how much is the R&D for the company in the last quarter? So.
My eyes are not working right now. Oh, there it is.
I have it right here. Okay, it should be 700.
A quarter.
Yeah,
700.
Okay. So we have 1.3 million, right, in revenues.
Yeah, let me get revenues out.
So then their cost of revenues is per their statement is 234 million, right? So you have 234, 425, plus we have the research and development, and that's how they get to the 82% gross margins.
Yep, I'm gonna get cost of goods sold up here for everyone.
Yes. So if you add research and development and cost of goods sold, you get 935 million of expense. Now, if you divide that by their total revenues, 1384, you get, from what I have here, 33% gross margins. Now I can understand how you could maybe have $1 billion plus in revenue and not be making money.
Yeah, and I love the question you're basically bringing up without saying it directly is that R&D is an embedded cost of the product itself, and so like when we think about cost of goods sold, it's the cost to bring the product to market and sell it. And so if you're removing that and you're basically putting it almost like separate, you get not manipulated, but confused or tricked into thinking that is just like something that they could stop.
Right.
Maybe there's a question about scaling, which we'll get to Salesforce in a second. I see someone saying no CRM, vomit faces. Okay, we'll get there. There's a question on scale, but yeah, I mean.
So until, and part of it can be just cost discipline from the company, but until you demonstrate to me that you have cost discipline, I'm putting your R&D as a COG expense, and I'm going to value you as if you're a company with a 30% gross margin.
Yep.
Then, and like I said, then I can understand how you have an operating loss off that, because it's like, how are you losing money with 80% gross margins and 1.4 billion in revenue a quarter? Like, it's impossible.
Yeah, on what theoretically should be a very profitable business, how are we not making any money? Yeah, that's the question, and there's tons of these.
Oh yeah, Atlassian's just one because I like the product they have, and they're growing fast, and I would love to get them, but at the same time, it's like, well, they can't turn a profit.
Hold up, I'm just curious. So let me start piling some of this stuff on.
Well, I don't think you can add, because SBC would be embedded within some of you, so you could be double counting a lot of R&D and COGS, so it doesn't really count. But yeah, point remains is you as a shareholder, you're quite literally just their liquidity. Hedge fund owner says Jira should be free. I didn't say Jira should be free. I said they should charge more for Jira. They need to make money. No, and this has been consistent dilution. It's not. Now, it does seem like they're getting closer to profitability, but at the same time, I mean, how long until you as a shareholder see any kind of capital return? It's gonna be so far in the future.
Yeah, and how saturated are they at this point? Is there a lot of room for them to grow?
Well, for them, I mean, to me, that's kind of like, who cares? It's irrelevant, because I'm more just looking at like software in general. And this is why I'm coming up with all of them.
Yeah. And okay, so I guess we can get into the topic here about software, Salesforce. Like, what's going on? Let's go to Salesforce. So, Salesforce has been pretty weak, and this is a company that I still hold. In my personal holdings.
I didn't know that.
And it's seen brighter days. Now the question is, where did I put you guys? Oh, there you guys are. I lost where I put StreamYard. It's like, what the hell is StreamYard? So you can see here, it's seen brighter days. Like, if you're short-term minded, still pretty good, but it's been higher before. But yeah. So what's the narrative that's kind of purveying here? It's AI is killing them, right? It's not just them though; it's everyone. It's killing Adobe. It's killing Salesforce. It's killing ServiceNow. Well, maybe not ServiceNow. ServiceNow recently has fallen. Workday. It's killing all of them. In fact, Workday in the last earnings call was asked, "Hey, what's going on? When's AI killing you?"
Yeah.
And Workday CEO was like, "Well, what did he say, Andrew?"
He said, unless something changed since yesterday, like, AI is gonna be very good for us. That was an interesting call. Listening to that call was very interesting.
So some of these businesses, in particular, I think Salesforce, Intuit, since someone's asking about Intuit, are among the best positioned for what will be like the distribution of AI tools. So you have Intuit that has a massive install base in the SMB side. And I think that is going to be, I want to be careful and say it's not underappreciated, because it is trading at like 30 times earnings, which is a hefty premium to some of these other SaaS players. And arguably it has one business line that I don't I appreciate it for what it is, but I don't like it as much. And that's TurboTax. I'm kind of iffy on the TurboTax business, just because there is always the potential that the government decides to stop being nice to them and make like the free solution really good. There's always that potential, but I put that as a lower probability, but still nonetheless a risk. But I'm really excited for QuickBooks. I think QuickBooks is the gem in that business. MailChimp. That's FinTech Boy's favorite acquisition ever. He looks at that and says, like, this is the example of what acquisitions should look like. If you can't tell, I'm being very sarcastic and I'm gaslighting FinTech Boy.
What did they pay? $9 billion for a mail company?
Yeah, exactly. Not their best time, but there's a lot of companies I could think of that Intuit should think about buying that could probably plug and play nicely into their suite, but I don't know. They're just not wanting to do it. They're starting to do buybacks. I don't know if you saw that. Again, questionable on the valuation, because they're just buying back stock just to buy back, I guess. But I guess, like, I wouldn't say the narrative there is like AI is killing them yet. They're still trading at a nicer premium. But Salesforce, for sure, that's present. For Workday, that's present, and a few others. Adobe, very much so. Now, I know Andrew loves Adobe. He actually says they have probably the best customer service on the planet, and something that everyone should emulate.
Yeah, I actually decided to make a company just to mimic the wonderful customer service of Adobe. That is my next venture. Is that so? No, I literally think who was the one that just got sued for making the unsubscribe button difficult? FTC just sued someone.
Was that not Adobe?
No. Hold on. It was. I have to find it because I want to say they sued. They did a lawsuit against Adobe a while ago, but I think a new one just dropped. Was it Planet Fitness? I don't remember. Anyways, oh Hims. He's a fintech boy saying Hims.
Hims, damn. Oh, they're not.
Yeah, cancellation policy. Yeah, it was Hims.
Oh, these guys are also on a dip.
Yeah. Hey, I'm trying to read like 2 different screens, man. But yeah, so Adobe, I mean, I cannot believe the difficulty to unsubscribe from one of their products. You're not even trying to unsubscribe from the whole thing. It's like, oh, hey, like I have too many seats. I need to do some seat management. And they're like, well, I don't know if I told you the story once. I had to like call their customer service because there's no way to do it on the website. Customer service sends me a form. I have to fill to unsubscribe, like to like undo, like for example, it was a Creative Cloud, just to undo a Creative Cloud subscription. So I go in there and they say, okay, fill this out and do this. And I was like, okay, so I do this, and I'll remove the subscription, right? They go, yeah. Like, okay. So I fill up the form and I send the subscription back, and they add a Creative Cloud license. They didn't remove it; they added one.
That's pretty bullish. I'm not gonna lie. They're really good salesman.
Very good salesman, but it's just like insane, and So, anyways, I hate that for Adobe, but I don't think Adobe's going to be like challenged with like AI. Just be like, Fabio, and pay the subscription, or are you paying for it? What'd you do that for?
A few things actually.
Mattress is like $4,000.
I have an Adobe Premiere, but I never use it now. I only use it to create memes. That's like once a year, like twice a year. Worth it. Worth the entertainment value, because I don't edit videos anymore at all.
So. Can I ask you something about Salesforce? Because I'm not in it. I've never understood the thesis on Salesforce. To me, it feels like it's a fully penetrated CRM company. They can do bolt-on acquisitions, but there's not a lot of like improvement there. Doesn't seem like there's a lot of like organic income growth.
Okay. So from when I bought it, and there's a video on Capital Mindset.
Right.
To shout out that old video, because I don't like to repeat videos, but if I can help it. In that video, the thesis at the time, and it was a very similar thesis to Amazon, was that they were going to turn on the cash flow spigot. They were going to profitability. They were going to focus on profitability, and suddenly you're going to see this massive amount of profits rolling through the door. That happened. My portfolio management of Salesforce probably wasn't the best and neglected, because other things were growing so much that honestly, if I was paying closer attention to it, would have exited the position, but did not, because at one point, if I was again paying closer attention to it when it was at like $360 per share, you were basically getting like a phenomenal exit. Oh my gosh. Well,
I'm not bullish CRM
because as a bear, yeah. So, yeah, you got probably a phenomenal exit for a company that had declining growth, and the bolt-on acquisitions. Yes, that is going to be a huge part of like the bull case, but it's betting on a lot. And if you're kind of really betting on a bolt-on acquisition story, I have already one that's up in front of us right now that has a much better track record of paying appropriate prices and actually compounding capital at a much more attractive rate. And you have all of their subsequent spinoffs, such as Topicus and the like, and Lumine, and they're gonna have more spinoffs. So I think they're already talking about an Australian spinoff. And yeah, we're probably going to see more of their business unit spinoff from Constellation. But
what's happened with Pine Tree? Has it just continued to go up?
Well, Pine Tree is low liquidity, and I think some people found out about it, and they're just bidding it up. But that's just like a holding co that invests in stocks. So,
oh, I know, but no, it's actually come down a lot.
Oh, good, because it made no sense. I think just like the Twitter tards found it and they just like bid it up at like market orders.
Yeah, it's down.
It's very low liquidity.
It's down 40% from the May high.
Good. It's a holding co that should trade at a discount too to the holding value, but you got to be wary about paying a premium for things that you could just buy yourself,
right,
and hold yourself. So you're really paying like a management premium.
Yeah, but the management does have a good track record. It's fair.
Oh, no, it's the son. It's not him. Now the last name, it's like imagine if I had a very successful career and then my son starts something, and then people are like, oh, he's got the same name, and then it's like, oh yeah, I'll just bid it up because same name. But what if he's a fuckwit? You don't know that. He might not be. Hopefully,
you're a little spicy tonight. I like this. I like spicy Fabio. Okay. What if he's a fuckwit?
Yeah, what if he's a fuckwit? But no, he might not be. And he might have been like raised under the same mindset as his father. But it's I think it's you got to be careful.
It's fair. I thought that his son had some experience or had done some good things within. Was it Constellation?
Yeah.
But okay.
But it's not Leonard himself.
Right.
So
yeah, I think Constellation is definitely probably more like, to me, if you're asking me CRM, Intuit, Constellation, I take Constellation every day.
Yeah, and I mean it's starting off a smaller base. One thing that is maybe I don't consider it too negative though. They're having to switch up their strategy to focus on more like larger acquisitions. So the deployment. Yeah. And I mean, like they're 60 billion US dollars. That 95 billion is in fake monopoly money. That's the Canadian dollar. So that's not real. In real money, they're about like a 60 billion market cap. So still a lot of acquisitions they can make, that would actually move the needle. And when you look at the strategy change, they're deploying now or attempting to deploy more capital, so higher price tags on the acquisitions themselves. The problem with that is there is a bit more competition in that realm, so you get a bit higher implied multiple on that acquisition. So if you take a $20 million acquisition or $5 million acquisition, I've told this to people all the time, like back in the day, like not even, I mean, right now you can go see this. Like if you find a really good, really small business that's like $5 million price tag, sometimes it's not difficult to find one trading for like 3 times earnings, asking price from the owner, right? It's not that hard to find. And yeah, right now when you're paying in the 200 million, you step up the competition. The bids start to get a little bit, maybe more aggressive. Private equity is there more aggressively. And so Constellation is going to be fighting even like the likes of Roper Technologies. So they're going to be fighting some heavier because Roper's focused on that. They were never too much of a fan of like the smaller stuff. Constellation dominated there, and they got like 26% return on investment in those investments back in the day. But now it's going to be coming down, and I think that's fine. But anyway.
Yeah, I just saw a comment from Fuhat. Did you talk about Cracker Barrel at all?
I did.
Okay. I don't know if you followed. Do you know what people are saying about this, or like why they made the changes?
I did not read anything about what people are saying. I saw one meme about it, but it's more so like Cracker Barrel logo was going to heaven, and it's like the other brands are all there: Aunt Jemima, Uncle Ben, and then 2 others.
Okay, so it's interesting because like the logo change and everything, I don't know why people are saying it's like use the term woke. People are saying it's like because it's a woke move, which it's in my opinion not at all, and I feel there is no evidence to support that like whatsoever. In fact, I saw people saying stuff like they said they're going to decolonize the store, and I looked at the press release and that word was never used, and they never said anything like that. What is interesting is the CEO. Do you know where the CEO worked before Cracker Barrel?
No, where does she work?
Starbucks and Taco Bell. What are they turning Cracker Barrel into? Fast casual. That's what this is.
Well, maybe I got to take back what I said because I didn't really look into it. Maybe this turnaround will work.
I didn't say that. I'm just saying, to me, it felt like a PE type, because she was the head of Taco Bell. I know she was definitely like Yum Brands China Taco Bell head, and then she was in the US pretty large. But look at if you look at the inside for the new store model and you compare it to the old, the new one reminds me of a Taco Bell. That's what I think of when I see that. So that's what I think they're turning it into, or they're trying to do, because they're trying to look at margins. Their margins have been getting eroded. So I don't know if it'll work, but they're doing it at a time where it's manageable. This isn't Jack in the Box, where I'm like, dude, I don't know how you get out of that. Jack in the Box thing is just cooked.
The store at the front they should reimagine, instead of selling like absolute cheap Chinese crap, selling other things. Not just like complete trash, but trying to rethink what could be trendy. The having like chocolate assortments, candy assortments, that's all fine. But you know, like some of the stuff in there is like, what are we doing here?
Well,
Who's buying this?
I think a lot of it also is an atmospheric thing, which to your point, maybe you focus less on like atmosphere and being like, hey, let's try to sell things. And so that's probably what it is.
The atmosphere,
even within the store, even within the general store.
Yeah, the atmosphere, I mean, like, was fine. My issue was the food getting noticeably horrible. So like when, we did family road trips, we would stop at a Cracker Barrel, right? Even though
I like their food.
What? I mean, it got really bad.
What'd you eat?
Like the eggs would be pretty bad.
Oh, I don't eat their breakfast. I don't know. I go there for dinner.
I'd only go for the breakfast. Dinner? I never tried the dinner.
Their fried chicken's okay.
Their chicken fried chicken? They call it that? Chicken fried chicken?
That's what you call it.
I didn't know. I just call fried chicken.
No.
Fried chicken.
That's what when I lived in the Carolinas, that's what we would call it. Like when you that kind of style. It's like the fried chicken, you put the gravy on top. That's all right. They have some decent dishes anyways. I will say, they need to fix their alcohol selection. That is some of the worst stuff I've ever had in my life.
Well, you see, I only go for the breakfast, so I'm not an alcoholic, and I don't drink in the morning.
Maybe you should become one.
I'd be more of a connoisseur. All right, Andrew, we got a question here to wrap up United Health, and we're talking about PayPal in 8 minutes. I see your comments. Refer to the schedule.
Short answer, yes.
Okay. Refer to the schedule. Refer to the schedule. PayPal next. I got to go to bed. Well, refer to the schedule.
It's a little later over there,
yeah. No, we're not looking at a tiny nano cap. I am not looking at that. Oh, we do have. Is this a ticker?
No, if you know, you know.
Oh, okay. If you know, you know.
Is it a ticker though?
What is this referring to? If I know, I know. I guess I don't know.
Nope, there's no stock. There's a.
I bring immediate.
There is a cryptocurrency.
$2. $2.
Oh, if you know, you know.
I do know. I know now. $2. It all makes sense now.
Yeah. Anyways, so
The dollar amount is very deliberate.
okay. So
don't worry.
you know you can watch this tomorrow too. You can watch. You guys can watch. This has
just-
a replay function.
It just hits different live. It just hits different.
It actually does though. I think that's true.
Yeah, because you know we go back and forth with them.
Mhm.
Just hits different. All right. 6 minutes. All right, but anyways, no software. I'm just teasing the PayPal people.
Okay. So with software, there's this narrative. I'll just go through this quickly. There's a narrative that AI is going to kill software, and I think that the majority of the entrenched larger software companies will be able to use AI to get margin and revenue upsell. There's one company that we're looking at that I think looks pretty promising. There's a few, and it's just about and this is why I think I was getting frustrated, because I was like, man, if these companies have some cost discipline, and I was like, well, maybe because you know, I don't know these companies well enough to know, maybe these R&D budgets are required to just stay ahead. You know, maybe if you're Atlassian and you have these products and you don't invest in them, and someone else is going to come along and replace you. So that's kind of the thing. So it's finding the companies that are focusing on profitability, that are focusing on making money, and seeing how they're going to do that, and then see how will AI agents or AI help them actually, and that's what I'm looking at.
Yeah, it's like a arms race, right? Where you're all investing in the weapons, right, that you're using against each other, and it's about like who's progressing faster, and do you have the ability to cut down on that arms race spend? Yes or no? Some say yes, some would say no. Like for example, there's another narrative around Adobe that I think is kind of funny. It's like the Figma threat, where well, I'll backtrack that. It's not funny because there's people who made legitimate cases like why Figma could
This
get
is a funny question. That's all.
No, Andrew snuck behind them with like a wire and just like went. I
was like, what was I?
It's like there can only be one Catholic.
Oh, that's right. He's Catholic.
There can only be one Catholic.
Jesus died for your sins, but I'm not going to.
So, yes, we have a strict policy on that. One Catholic per panel. Long shot. Anyone looked at Gamb, affiliate marketing and sports betting subscription software company that has 10x since 2018? They sound familiar.
People have talked about them a lot.
Oh, this is Beater stock.
Lamau.
Gambling group. No, I think he's talked about this one to me. I can't really comment too much on this one because I don't know really what they do.
Pumped Gamb before. Affiliate marketing?
Wait, did the Beater stocks talk? I've pumped Gamb. Yeah, okay. So I do remember.
I mean, I don't know if it's that ridiculous. They have a net loss of 13 million last quarter. Is there a reason for that? Their revenue grew 30%, but their net margins went from 23 to negative 34.
Wait, is this still GAN?
No. GAN got acquired. GAN's different.
Okay, GAN got acquired. They're gone. Okay, I remember GAN. No, GAN's still here, or is it gone? Is it? I think it's still here.
No, I'm pretty sure it's getting acquired. It might still be a stock, but I think they're getting acquired.
No, I don't think it. Yeah, no, you're right. It got acquired. It's gone. The last price update was May.
I just don't know. I mean, I'd have to look into this, but like, I will tell you right now, affiliate marketing. It'll work until it doesn't.
I have Evo. I got all the gambling I need.
But you could make. Why has it been selling off? Like, why is it down? It's stock down, stock bad. Why is it down?
Stock down, stock bad.
Why is it down 40% since May? Like, is there a reason for that? Like, that's a pretty drastic drop.
Yeah, we're trying to avoid saying stock down, stock bad, but that's like the summary of all of our analysis. So that's how we meet together. Andrew and I call each other and we go stock up, stock good, stock down, stock bad.
So like, do we want to buy this stock? Well, what's done? It's gone down. What a shit stock. That's bad.
Dude, bad. So, short. Yeah, so it's down 50% from its recent high. So free cash flow positive, but like, is this on IFRS?
It's listed on the NASDAQ.
No, never mind. Jersey. I saw UK, rest of Europe, international. Okay, no. It's Jersey. All right, so Gap.
Okay, let me see if I can find like a earnings release trend. I mean, I'd have to understand what. Actually, no, you're right. They are international. They're not. They might be on IFRS. They're an international company.
If they are on IFRS, all of these data aggregators are fucking up the free cash flow. I can tell you that.
Yeah, they're doing 6Ks. So hold on, let me see if it's IFRS or not. Kind of.
Yeah, if it's on IFRS, I'd be very weary about using your data aggregators to look at the free cash flow here. I have a video, very old video, talking about how to calculate free cash flow on IFRS. It's one where I talk about that one British company.
There was a number of standards, interpretations. The group is still in the process of assessing the impact of IFRS 18. Yeah.
You know, it's something they typically all have that they do like an adjustment for American investors. They calculate the EBITDA like at the end to like stop confusing people. They'll say, look at our EBITDA, and they have no debt. So it's also like, you know, it's a fair look through. You're not ignoring the cost of the debt. I saw there is some debt here.
Yeah. So, for example, their gross margins are always IFRS gross margins for whatever reason are immaculate always. And then you have to kind of get like into what it's like. Might not be worth a headache, to be honest.
Yeah, and by the way, the PayPal people are gonna flip their shit if we don't, start talking about PayPal. We're past the time.
I don't think PayPal is very good. Okay. Anyways, back to the other stock.
Oh my gosh!
Just kidding. Actually, I like PayPal. I think it's interesting here.
All right, and for context, for those of you who do not know my stance on PayPal, I have not liked PayPal for a while, and my stance has changed. Now,
to be fair, Fabio, what did you call PayPal 2 years ago?
Dead money.
You called it dead money. What has it done since then?
Dead money.
It's gone up 4%. You were wrong.
Oh wait, I was gonna say it beat my SGov. No, it didn't.
Didn't even do that.
It did not beat SGov. This is also true. Anyways, that's the past, right? That's the past. Oh my gosh. By the way, Fiscal, if you're in the chat, I'm telling you, the subculture within Capital Mindset, because we're at the size where we have subcultures, right? We have the main culture, we have mainstream culture, we have subcultures. The subculture, what they've effectively done just now is they've challenged you physically. So you have to, like an ape, kind of and then you'll gain the respect slowly. But I was trying to explain to you in the server that don't back down.
You back down, you're done.
Yeah, you back down, you're done.
You go in there and you say, "I'm sorry, guys. It's not gonna go well."
you got to stand up for yourself. But yeah, that's we call them the frat boys. That's what I was telling Blake also. You got to ball bust. They ball bust. You got to ball bust back. If you don't ball bust back, oh boy, it's not bueno. All right. Anyways, because I thought you were laughing at that comment, right?
Which one? Yes.
Yeah.
Dividend do one?
Yes.
No, fiscal. Well, I don't know if he knows where the frat boy headquarters is at. He has to go there to infiltrate them.
Yeah, you have to face them one-on-one. You got to go into the pit itself. All right. Anyways, so no, let's kind of walk through the PayPal thesis. There's a lot to go through, so let's get into like what was bad about it before. Why did I call it dead money? Well, the first point of contention started when the old management was in power, so to speak, and they had this wonderful asset underneath it, Braintree, but Braintree was growing at the cost of margins, and so like we saw a lot of their take rates starting to erode. The core product itself, while on the surface is quite attractive, was also facing a lot of progressive competition that was starting to slow down growth, or at the very least, reducing its ability to penetrate further. And so we saw that in the eventual decline of usage of members. But, well, we'll get to the but. The but will come later. So this is in the past. And on the top of that, they had this asset called Venmo. That was another gem that they had really done nothing with it. In fact, our fintech boy, who's in the chat probably, is one of the main critics of this acquisition, basically saying this is something that they have that's actually pretty good. It has a lot of potential, huge user base, but they haven't done anything with it. And that was correct. You could see that. Let me think of what was the other thing. Oh, yes. They also had this growing business that arguably wasn't really their bread and butter, BNPL, which if you're not going to focus or entirely on that, are you going to really be all that much better than the likes of a firm? So something that was for them going from a capital a business that doesn't carry tons of loans on the books to a business that suddenly is going to carry lots of loans on the books was also something that I found just problematic, just prone to risk. They were doing too much all at once instead of what there should be focused on is just basically being an intermediary for transactions, which is what PayPal was always good at. Okay, so fast forward today. Well, what's changed? Well, the new CEO comes on. Well, actually, we won't fast forward to today. We'll kind of go where the new CEO enters the screen. And he makes a bold proposition. I think this pissed off a lot of investors, potentially. We're going to shock the world. So come do the moment of shock, and it wasn't very shocking. They just basically introduced the fast lane, which, again, if you actually listen to what the CEO says the potential is there, he's very bullish on it. He's very excited, but no one cares. Don't you hate it when you're so happy about a project? Everyone's like, "What the fuck? Who cares about this?"
Yeah.
So that's kind of like sad, but I see it. I see it for him. And he made a lot of bold promises as far as improving the margins, the profitability, and focusing on renegotiating a lot of the Braintree contracts to just make them a bit more tenable versus where it was before, where they were just trying to lowball Adyen and take market share. And Adyen talked about that, where they were actually seeing signs of their growth slowing just because Braintree was coming in and saying, "Oh yeah, no, we'll just offer you like way lower." And then of course the customer's like, "Yeah, sure." So that's, again, old management team, new management team comes in and starts making progress towards that. Now the whole retail investor base is already involved at this point. So you have massive involvement by people on FinTwit, people on YouTube. Well, actually, arguably, I think it was way before that. I think people were making buy PayPal stock videos at like 200 plus. I remember I did a reaction video to a particular YouTube content creator who I think left the platform, and they had put like a price target, something crazy, and my whole video was like a critique of that. And I remember doing subsequent update videos to PayPal. You guys can go check them out, where I gave a fair value price target of about $70. Well, we just so happen to be at $70 right now. But fast forward, they did actually do some more changes as we kind of progressed through. He made a deal with KKR, which he started to offload the BNPL portfolio, which got PayPal, I think, back on the right footing, where they are facilitating these transactions in the BNPL, but they're not becoming a heavy loan book portfolio. Like I would say Affirm is probably better suited for that. Same with Klarna, et cetera. But for PayPal, it muddies the story. It muddies the books a little bit. I would prefer them, and I stated this when they made that transition, to just stick to being simpler. Complexity can be problematic in and of itself. Of course, like arguably they're leaving money on the table, but I would prefer them to just be, again, just this intermediary between those two. Okay, and then going on to more recently, so now we're actually fast forwarding to the modern era. PayPal has made some interesting changes. They've been actually monetizing Venmo a lot more. So we're seeing actual improvements in this asset that just sat dead in the water. Andrew, you wanted to say something?
No, I said yes. I was just agreeing that Venmo, I heard people saying something about how Venmo sucks and Venmo doesn't, it's not monetized right now. And I was like, that's very bullish, actually, because you can then monetize it. It's like saying because if you're looking at the company moving forward and saying that they have this massive base of consumers that have not been monetized yet that are on their platform, that is an opportunity. But go ahead.
Yeah. And I think that the confirmation, right, that the CEO was going to make certain changes, like a lot of the bulls are fatigued right now. And so I know Beater isn't, right? And Beater, you and I were talking, you're going to buy more PayPal, right? But a lot of bulls out there are pretty fatigued at this point, actually even making crazy capital deployment plans for the management team to forego buybacks and do dividends instead, which I don't agree with. I don't understand at all, especially considering that.
I think that opinion was lack of any intelligent thought.
Okay, I don't want to be mean, but
that's the honest truth.
Yeah, well, yeah. Because like if you think about it this way, I have yet to see any case study where you show me that someone becomes the last shareholder standing. So if the fundamentals are in fact improving and not deteriorating, key fact, that's the key to this whole statement I'm about to say. If the fundamentals are improving and you're trading at a multiple that yields a very high earnings yield, and you proceed to repurchase shares, I have never seen it ever. And if you find one, let me know, because I guarantee you won't find one where you are the last shareholder standing. This is, again, gets back to the whole comment of like why fundamentals end up mattering always. And it's always like there's no such thing as free money, right? So if I were to buy shares of a company and they were to repurchase all of the shares outstanding, because somehow the market didn't respond positively eventually, and eventually all the shares are gone except for mine, I suddenly have become a billionaire very quickly, which would never happen. It can't happen. You will never find such an example. I want to say, right, to be more precise, in the modern era. I don't know if you go back to like 1920s, you find some random, complete arb that existed because everyone had to go get a new book.
The company did like a tender offer, and one guy was like, "No, I'm going to hold my share." And he's like, yeah, "I'm the sole shareholder."
Otherwise, I have not seen it in the modern era. And modern era, I'll be generous and per se like 1950s onward. I don't know about the obscurity of back then, but doubt you'd find one. And that would be a just a quick dirty way of saying like, yeah, just became a billionaire. How did I do it? I bought shares and then they bought back the whole company. So the fundamentals are now improving. They are buying back loads of shares, and they're not doing so with leverage. So keep in mind, all the buybacks, well, for the most part, all the buybacks effectively are supported by the free cash flow. Now, that is going to have a strong impact on forward EPS for this business. And so you're going to start to see that really pick up. And if it stays like this for longer and the fundamentals do not deteriorate, it's only going to be a coiled spring. Now, timing this, obviously, it's like whoever's guess. Like, I don't know when PayPal is going to be $120 per share, but $120 in like a 2-year time frame is not very unreasonable. So what are some of the catalysts that take you there? So you have a few. You have continued improvement in Venmo, no deterioration or slow, if anything, but no deterioration in the core business. And you have improvement in Braintree. We got the Venmo improvement that the CEO promised midpoint of this year. We already got that. And now we should still keep an eye on that. And then the promise of Braintree improvement and acceleration or return to growth in Q3 of 2025. So that's your next catalyst. If the market looked at the Venmo one and did not care, how do I know that? Well, if you go to the earnings transcript, he said something along the lines of, I know no one asked, but Venmo. And so, yeah, I know no one asked, but Venmo. So it's not an exact quote, but it's something along the lines of that, where he basically gave an update, and no one asked really a question about Venmo up until that point. But Braintree is more, I guess, looked after by the analyst community. And I think investors might be a bit more spurred to see Braintree reacceleration. It's considered to be, again, one of the, or if not the most gemstone or gem-like business inside of PayPal. So that's summarizes more or less like the changes from going from where I disliked the opportunity in PayPal, or I thought there were better opportunities, is probably the more accurate way to describe it, to where now I'm at. This probably has got a lot of the dirtiness behind it, and now we're looking forward at seeing, what are these improvements going to look like, and how that's going to drive down to the bottom line profits and be responded to by an increasing share price.
Mm-hmm.
So a credit to Alex Chris here. He actually should take a lot of credit for that.
Yeah, it's kind of like they've done a good job building out what I think is a decent base to then start to grow their product offerings. It seems to me, and like I am not a fintech expert, I'll say, but like seems like a lot of times with these fintechs, the thing is you have to do is like you can't just go and like instantly monetize something. You have to build out the base and build out the customers and like get a product that people are going to use.
Yep.
And then you start to turn up the monetization, is what it feels like.
Yep.
Because you just trying to monetize it before you have a large enough demographic to really make a dent, revenue wise, doesn't make any sense. So you get that base, you get strong. That's the thing with Braintree too, right? All those low margin, because the issue was they're pulling off the low margin contracts. They are no longer lapping that comparable, right? In Q3.
Yeah, they're no longer lapping that.
So there's a lot of things that'll be interesting. I don't hold any, but I think it's really interesting.
Yeah, and I hold it's considered a percent of the portfolio to be on the smaller side, but with leverage. It's a leverage position. So
yeah, I mean, what's their buybacks impact on the shares out right now? Like, what has it been?
So it should be reducing right now, anywhere from 7 to 10%, depending on where SBC is at per year. Because they're throwing everything now at it. So I say 7 is probably more accurate, because I think the buyback yield is closer to 10%, but there's SBC definitely in there.
Mm-hmm.
I think for the management team, their comp, their bonuses are going to be dependent on if they reach a certain target, share price wise. But yeah, if it stays like this for a while, with improved fundamentals, then yeah, you are looking at a coiled spring. I don't know for certain, but I have a suspicion that it's going to be Q3, Q4 of this year.
So if you do basic shares out, they went from 1,042 to 969 year over year. So 7% reduction.
There you go. Yeah, because in my head I didn't know the exact percentage, but I just guessed it was going to be 7.
Mm-hmm.
But it's a 10% buyback yield, 7% effective yield.
Yeah. So I mean that's good. I mean I do think it'll be a really good upcoming quarter from them, and I think the company's it looks good on a go-forward basis.
Consider this as another like fluffer for the stock. It's it's a business that doesn't necessarily need a lot of new incremental investment. So they're able to do that, what they're doing. They're able to just grab tons of money, basically all of their effective earnings, and just throw it back at you.
Man.
Adyen is suffering from the same problem, which I'm also a shareholder of Adyen. But I mean, Adyen, you're looking at them and you're like, dude, these guys are just making so much money. They're literally piling up. I think they're at, well, officially it's like 12 billion. I think what their corporate cash pile is a little bit less than that, because some of that cash is like what they hold for their clients as like an intermedium, but they generate interest on it. So it's getting to a point where Adyen's interest income is pretty it's getting up there.
Yeah. Well, this is a good question. Where does it rank in your list of payment companies?
I have a list there. So you want to go first, or you want me to go?
You go. I'm trying to think.
So definitely at the very top, I'm gonna cheat a little bit and saying number one is for longevity and branding is probably something like an American Express, but very closely followed by Visa and MasterCard. I put them there, or American Express there, is because American Express will survive any sort of potential threat to, like, some sort of tokenization or stable coin. It's immune from any of that because American Express transcends that. So it's much more than that. But they have their own network. And then Visa and MasterCard are very close right there, because I'm not so confident in terms of like their displacement. But I can almost like say, because I was asked this question before, among the three of those three, which one would I think is the closest thing to a buy and hold forever? And I'd said American Express. Then Visa and MasterCard are right there. Then following that, I think you have definitely Adyen. And then, believe it or not, I actually think PayPal takes the cake over something like a Stripe. But Stripe is very close.
Oh, you're just saying like in general the company, not like stocks.
Well, I'm mixing a little bit of both in that.
Okay.
So Stripe, if Stripe was public, I don't know if I would buy them necessarily over in Adyen if they were multiple was the same, unless the growth was just very different. But to my understanding, they're not growing at too different of a rate between the two of them.
Yeah, I think that's.
No, we know that, Les, by the way. And for Les's comment that American Express takes credit risk and MasterCard and Visa don't. Yeah, we get that. But if there's no, like I was just saying, there's no threat or any perceived threat really, as far as like removing their
yeah, and in some ways being the credit issuer is not always it's not always a bad thing.
Yeah. It's not a bad thing if your underwriting is really good.
And you have like the highest demographic for your highest income demographic for your not your highest demographic. It's not like you're all high tech customers, but like your highest income demographic.
Yeah. And American Express is also kind of like a weird one, because like their branding power is so strong. A lot of their profits, it's like the Costco model, right? For like the memberships. Right? They just keep upping those membership fees and people pay it. They don't lose anyone.
My favorite payment companies are Klarna and Affirm. I use them more than anyone else.
You got Andrew, or I was thinking almost, yeah, in a way they're payment companies. Yeah, because they're.
Totally. Yeah. Rob, Gen Z? Out of curiosity, are you a Gen Z? Just curious. Give him probably a minute to respond to that. But yeah, I guess depending on how you look at that. Negative, interesting. And you're not younger than a Gen Z, right? You're older?
He's like, I'm Gen Alpha.
Gen Alpha would fall in what I would think the demographic is most likely.
Yep, Amex.
Yeah, I'm just wondering because it's disproportionately more popular in Gen Z and Gen Alpha versus older demos, but older people are starting to become more into it. And I don't want to go too into this because I'm very much a buy now, pay later bull. But and I do own a firm, but I think that it is one of the most misunderstood industries out there. Like everything you talk about, it's like buy now, pay never. I think we've talked about this before.
The videos.
The videos hold this it's cognitive dissonance. I don't know. It's like these two simultaneous arguments. That is, these are predatory companies that take advantage of stupid consumers, and they're just these predatory, awful companies. And then on the other side, it is they are unprofitable, will never be profitable because no one pays them back, which both are not true. So
you can't have both opinions and both of them be true. Yeah. But also both of them are not true.
Yeah. So anyways, millennials love buy now, pay later just as much. Yeah. Yeah. And so anyways, yeah, if you're including the BMPL companies, I mean, firm. Well, no, because if you're talking about longevity, you got to go Amex.
That's what I'm using.
And MasterCard, Visa. I don't know Stripe and Adyen as well as you. Someone said Discover, but I wouldn't put Discover isn't. They're Capital One.
So yeah, because the thing with Discover is a network, but not a network as strong as Visa and MasterCard. Mm-hmm. And then it has Capital One, but Capital One is not as strong as Amex. So the reason why Amex is so high up on the list is where it occupies and has occupied for such a long time in the mindset of the consumer. Mm-hmm. So it's way more than just like a network. It transcends that. If stable coins, take over, for example, and it's a world where everyone, was not pricing in that Visa, MasterCard are out because they're still trading at elevated multiples. Mm-hmm. But let's say that world happens. Amex survives that. Amex will not die from that. Amex will transcend that. And then all it will happen is it's basically a membership card. That's all it is. It's a membership. It's a club. You choose to join and you get your coupon book. You feel good. It occupies a mind space that you're like, oh, this is cool. That Capital One just does not occupy. Capital One is, traditional bank credit card you go for.
Just use Klarna to buy smoothie on installments.
Is your portfolio really 80% payday lending?
No. No. Any concern that buy now, pay later will become a crowded market or too hard to break into? Anyone that lends money, I mean, you could have asked the same question for credit cards or anything like that. There is a moat in some of that's your underwriting, some of that's your base that you've already built. There's a lot of different things.
Wait, I think what you and FinTech Boy, Garzi, don't highlight enough to the people because you guys think it's like, oh, it's obvious, but highlight it more. And this is where people will click. Why is BNPL better than a traditional credit card? Not to the
merchant no. Can push it.
No, not that. No. That's what you guys push. That's what you guys highlight a lot. So I'm talking about as a business, what makes them maybe more attractive. Okay. So I go on my Affirm app and I want to buy something. What do I do? Walk me through the process. And I'll go, aha.
Well, I know what you're going to, okay. I know. So you go, I want to buy something at Home Depot.
Home Depot. What am I buying?
You're buying a shovel to bury the bodies in the backyard.
Okay. I'm a serial killer.
That is right. And so you go and you say, hey, I'm trying to buy this from Home Depot. I want to buy this shovel. Mm-hmm. And a firm says, okay, at Home Depot, here's how much you're approved to buy.
What was that?
That was underwriting at every level or at every transaction.
What I just did was the Leonardo DiCaprio.
Yeah. or
Oh, there.
there's also like I also like the one people share sometimes where it's like, how can they do it? They can't, or how can it be possible? It can't be. It's paradoxical, but it is. From what's it from? Oppenheimer.
Yeah.
Yeah. So, but yes, so it's underwriting every, and I've tweeted that before. It's like, imagine if you had a credit card and you said, this credit card, the card issuer underwrites every transaction. People be like, oh my gosh, that's like an OP card.
And I'm not saying you guys don't say that. I'm saying that's what, if you to reach people and get them to have the aha moment a little bit, that needs to be highlighted like way more, because
I don't want them
people
to
are
have the
focused.
aha moment.
Oh, okay, that's right. No aha moment. But that's what makes it really good from the perspective of a business. Like, you're underwriting the trends, like every transaction can be underwritten. So what does that allow you to do? It's the flexibility. But okay, Andrew, let's go back to the example of a credit card, because now I'm gonna have a credit card, right? Same example. And I just lost my gerb, you know. I want the shovel. Can you stop me? Can
Is a
you
credit card?
quickly
No.
pull back? No, you can't. So that's the not the friction, but a major difference between the two product classes. Like, what makes
Yes.
one a little bit more attractive for underwriting. So if let's say we go through a recession, one of these companies can proactively pull back across their lending portfolio, become more strict, but the other one cannot. The other
Well,
one's gonna have a
don't
much
you have to
harder
give a
time.
notice before you pull back credit on a credit card?
Yeah, but it's not going to be as instantaneous, because you're underwriting every
No.
transaction.
No, hold on.
And I'll explain further what I mean instantaneous, but go ahead.
Oh, okay. The Card Act requires 45-day advance notice for significant changes, but this is not always doesn't always apply to credit limit decreases. Okay, I thought they had to notify you before. Okay, so yes, but to your point, the BMPL underwrites every transaction, so it's going to see, oh, you lost your job. I see your paycheck not hitting anymore. No, thank you.
Yep.
Whereas the credit card issuer won't necessarily do that. Now, you know, am I saying that like these BMPLs have way better delinquency rates than credit cards? Not necessarily. You'd have to depend on what credit card you're comparing it to, what issuer, things like that.
Probably not
But
Amex, but
definitely not Amex. But the point is that it's not degen, except for Sezzle. Sezzle seems pretty degen, and yeah, stay away from that one. But all the others don't seem that degen. I don't understand Sezzle. I don't know how they have no cash flow.
sorry, who doesn't have cash flow?
Sezzle?
Oh, Sezzle. Well, isn't Sezzle you got rejected from Affirm and Klarna, so
Sezzle,
you came to us.
Sezzle doesn't. Yeah, they are the everyone else has rejected you, we'll take you. It's the remember how I was talking about like at the mattress store, there's Synchrony, and if you get rejected from Synchrony, you go to the other guys. They're like the other guys, and they're in their product. They charge you $18 a month just to access their platform. So you're like desperate to go there.
Well, I spoke with someone like 5 weeks ago, something like that, where they actually told me that they defaulted on a credit card in the past completely. Yeah. And then they got rejected from Affirm and they got rejected from Klarna, but then they got accepted and they're like, yeah, I'm using this thing, Sezzle. I'm like, oh my gosh.
Oh, there it is.
Oh my gosh. And then you pointed out in the last earnings, I don't know if you're about to mention this, the delinquencies or the cost of bad debt for Sezzle.
Oh, their provisions?
Yeah, their provision for credit losses. It's
those
insane.
are bad. But what I'm actually trying to do is go to their annual reports. Let me see if I can get it.
While you're looking for that, I'll answer Daniel's question. Apple Pay is growing at a CAGR of about 4% since 2020.
So,
and while you're also looking for that, Prattman, yes, I've looked into Pay USD. They're getting like final approvals, getting things through the hurdles. And so that's like So everyone's excited about stable coins, right? And PayPal has one, and everyone's like, whatever.
So here's my thing: is when I look at a company like this, and Sezzle bulls have told me it's seasonal. Yeah, but my issue more isn't the provisions necessarily. It's that they don't have cash flow. Here, I'll share this, and I'll zoom in. So, like, I was looking at the first half of this year for Sezzle, for the first half of 25. Now, this is the last 10K, because I was like talking about how Sezzle has terrible EBITDA to free cash flow conversion. It's awful. I mean, so this is net income. Your net income is 78 million, and your cash from operations is 40 million. Like, what's going on here, right? Generally, your your provision for credit losses is 55 million. So as a percentage of your cash flow, it's kind of high. But I mean, you could argue that this capture. I mean, some of this is capturing that, so it doesn't matter. But and so because when I was looking at this is the 6 months ended June 30th, 2025, 63 million net income, 22 million in net cash provided by operating activities, and that's below last year off. So it just doesn't make any sense. Like, and I could go into a bunch of other things. Like, I don't get how that works. And remember, this is a company that's also taking leverage to do buybacks, which like is another thing. If I'm worried about your cash flow conversion, and I also think you're a company that could be very sensitive if there's any pullback in the consumer, this would be concerning. Now, to be clear, I'm not short Sezzle, so yeah. But no, I'm just kidding. But I just I don't get this one. When I think and to be clear, I wasn't even aware of Sezzle that much. Like, I'd heard people talk about it until Garzi mentioned it, and he basically said, like, I don't get why people are all about this company. And then I looked at the cash flow and I was like, why am I paying $3 billion for a company that can hardly spit out, any money? But so, anyways, ran over.
I have another topic. So for us to get into, and then this will be our final topic, but we have to revisit it because we've been saying we're going to talk about this on a public stream. And the people must know about TSSI.
What about TSSI?
So maybe people don't remember, but there was a live stream, a while ago, and I think it's in under. Oh wait, no, this is not the right one. Hold on, give me just 1 second. I have it here. This one.
Is Sezzle the kingdom of finance of the buy now pay laters?
Yes, it is. All right, here we go. So this is the one. So this was from about a month ago, June 26. So TSSI.
Are you gonna play a clip right now?
Oh, I didn't even watch this.
Oh, okay. I wasn't sure if there was a clip.
I don't know what. No. But this, I just tell everyone, if you want to go watch our thoughts on TSSI, go watch this. The TSSI and the retail pump and dump. It's timestamped. This was again posted June 26, 2025. You can see the title here, and you can go.
Oh, you're on the wrong screen. But yeah.
Oh, sorry. This is the title, and then you want to probably go to this timestamp and watch our full thoughts on TSSI at the time. And that's again if you want to. Venezuela news. Something just broke.
Venezuela.
Wait. Can I act like super like mad because I'm like, oh my gosh, my country. No, Andrew.
They fire a Fed governor?
No, Venezuela news. It says Venezuela news. Oh.
I'm just
pause. Steve, don't give us fake news. Come on.
Venezuela sends 15,000 troops to border as U.S. warships approach.
Oh, come on, dude. It's like a ragtag team of like farmers.
Dang.
It's like 15,000.
I bet you wouldn't say that ragtag team pulled up to your door.
No, definitely not. There's a big difference. That many people pulling up to my door is very different from, having the full force of the United States Navy right in front between us. Very different. So, spoiler alert, this was actually the top of TSSI. And Andrew here was bullish. I was bearish, naturally. And so he was saying it was going to go higher. I was saying this is the top, and the retail pumped it, so you better get out. But Andrew was like, no, this is just getting started. I am gaslighting completely. If you go watch it, Andrew's basically saying, get out. These retail pump tards are I'll say it politely, stupid.
You could say devoid of any logical thought would be another kind of way to say it. But yes, and it has since gone down to an area where I think it's good to look at accumulating.
Yes.
I don't think you make it I don't think it's at the area where it's like this should be a massive position, but I think it's a good accumulation area.
Our live streamer indicator still good? Yes, it's still good.
What?
Because it was a certain someone who did, the one who gave us that exit liquidity.
Oh yes. Very useful.
Very useful. I mean, we made a killing. I think most of Capital Mindset made a killing on that.
Someone became like a millionaire off that.
Yeah. Shout out to what's his username these days?
I'm not gonna give away his name. I mean, if he wants to expose himself, he can. But someone made themselves a lot of money off that.
I'll say he's Canadian. That's all I'll say. He made himself a U.S. millionaire, but in Canada. So it's like, wow.
He didn't just create generational wealth. He created like multi-generational wealth.
Yeah. He can buy a house now. He can buy a house now. A single house. Or sorry, a single shack.
That is wealth, though. There.
That is wealth. All right. So, anyways, TSSI. It's back down to the level where we think it's a decent accumulation. The retail hype has died down a lot. Andrew actually posted on it on Twitter, and he got a lot of, not hate, but
pushback.
Pushback is the right way to say it. Pushback
on both times, by the way. When I posted that I sold out fully on June 28th,
people called you an idiot.
People were like, TSSI is going up. Like, look at the earnings growth, look at the revenue growth. Like, it's going to go up. And then when I posted recently, hey, I think TSSI looks interesting here. Did you know that they're just Dell's little bitch? Did you know they're just Dell Overflow? Did you see it? Dell is building up their own facility. This company shouldn't be valued. So I was like, man, so you guys are just finding out what I knew the whole time. Okay. That's fine.
And to be clear here, with this being the case, it's so the volatility that you see expressed in TSSI is a reflection of the investor base being, primarily retail, and there's just a complete lack of research and information. In fact, some of the most prominent, I guess, characters that talk about TSSI, in fact, seem to have some sort of gap in the understanding. So again, apparently the Dell overflow has been a surprise to a lot of people, and no one reads the contract, or no one knew that Dell did a lot of the stuff TSSI does.
No,
Echo.
Yeah, I don't know. It's just weird.
I don't know where. It's almost like you don't even know what TSSI does if you thought that it wasn't.
To be fair, like someone said this term to me. No, it's not someone in CM. I was talking to them about on a different position, and I said, "Wow, like it's crazy how people are invested alongside me, and they know absolutely nothing about this company. I hear them talking; it makes me like bearish the company."
Dave,
and,
yeah, I know.
well, I was talking to this individual, and he goes, "It's called vibe investing. The vibes are good, man, so they're gonna buy."
The person told you it's vibe investing?
No,
And they
no. No. The person. Well, this person knows Dave very well. This person has been in Dave since like $10, and not a CM member, but they were saying when we were, because they were in a space that I was in, listening to me talk about some other people, and they were just like messaging me, being like, "Man, these guys know nothing," and we were talking about that, and I said, "Yeah, it's just crazy that they what do they even invest off of?" And he was like, "Vibes. The vibes are good, you invest. If the vibes are bad, you don't invest." I was like, "Oh, that's true. It's just vibe investing."
And speaking of vibe investing, weed.
We what?
No. Mary Jane.
Oh, pay
Um,
attention to the. So, what is MSOS done? Is that the one? Oh wow, it has just started pumping. Wow.
Yep.
So what I think you do with this, if you're looking to short, you wait for the momentum, the upside momentum to break and start to go down if nothing happens. I actually am of, and this isn't like, I'm not going to get political here or anything. I am actually of the opinion that this administration has the highest chance of any administration. Well, obviously because the other ones haven't done it, but I would say it's the highest chance of any of them of legalizing it, because this administration seems very, very focused on just finding ways to increase tax income or, uh, profits for the U.S. government. And I feel like federally legalizing it and having an excise tax on it would be one of those ways. And so I could see that happening. But until you get confirmation that it won't happen, because I'm not saying that it will, but if you get confirmation it will not happen, you will have time to short the downside. I would think that's what you would do, but
And the final topic of discussion for funsies.
Mhm.
Open Door.
Am I allowed to say that Eric Jackson is at best a retard and at worst a scumbag?
Well, you already said it. I mean, can I say this? Says it.
They say it's better to ask for forgiveness than permission.
Well, tell us how you really feel.
Yeah, just to be clear to fake alias, states are taxing it, federal government is not. So federal government, I think, wants a slice of that. You know how profitable it's been for those states? Okay, so Open Doors is a dying company in an industry that does not work. Zillow has said it doesn't work. I think Redfin said it doesn't work. There was this whole thing where iBuying people thought it could work. And by the way, their entire share price rise, it's come at deteriorating fundamentals. So I think they guided for a 50% revenue cut quarter over quarter at the last earnings call. The only way I think this company lives is they have to do a dilutive event. Now, I don't know if this retail cult is going to let them. Yeah, they did 1.6 billion of revenue in the second quarter, and they're guiding for third quarter be between 800 and 875 million. So this is a company that does not work. Now, I read the bull thesis. Also, you have like Anthony Pompliano pumping it for whatever reason, which he's one of those guys that I will say he got lucky in Bitcoin. He is not, in my opinion, relatively intelligent, and he was a Bitcoin pumper, and it makes complete sense that he would just go from pumping one worthless asset class to another. And so that's what he's doing with Open Door, is like he's just talking about it and trying to get it to pump up. And it's this whole weird thing. Like, he wrote an open letter to the executive board and directors of Open of the retail sourced ideas for them. And here's the thing about this company that I think, with a GameStop, if you have a big retail following, yeah, maybe I'll go buy something from GameStop, and if everyone does it, it actually has some incremental value to them. If you have what's the other big ones? A Robinhood, people go and they use Robinhood as their primary broker. Dude, I'm not buying a house on Open Door because I have Open Door stock. Most people doing it don't have money to buy a house. And so I don't think it has that same attractiveness. Now, we'll see what happens. But basically their thesis is like AI agents will do home buying for people in the future. So you'll automate your home buying through an AI agent, which I would push back so strongly on that notion. That is an insane notion. And so then Open Door, according to them, has the best market and best knowledge of housing prices and will be able to facilitate that, when that's actually Zillow. So if you're actually bullish, that you just buy Zillow.
Yeah.
But this is not an actual bull thesis, in my opinion. This looks more like something like a stock promotion into a dump at some point. If it hasn't already happened, because we don't know what Eric Jackson holds. He's never posted what he holds.
Yeah. And he keeps going on every place that accepts him. He's like throwing out $80 per share. He's like, he's not even thinking about selling until he gets to 80. And it's like, I mean, he knows what he's doing. So.
Yeah, and he's just trying to pump it, and it's worked. Good for him,
So
I guess.
Like, we're actually witnessing, the limitations of what we can do. I say evilly.
Oh. Well, the funny thing about this one was the fact that it caught any fire, because, and actually you see I think the reason it was down today was OfferPad was up 130% today.
Let me say, on a real note, we would never do this. I am just surprised you're able to do that, what he's doing.
I mean, it doesn't surprise me at all. I have witnessed how little effort any of these retail investors put into a stock that they buy. They read something that's like, Open Door is the future. Of course, home buying is a big market, and Open Door is the future of home buying. Buy the stock. And that about aligns with the amount of due diligence I think they would do. Yeah, OfferPad's up to 364.
Oh my God, even more of a piece of shit company.
It's up 130% today.
Oh my gosh.
So I think it took some liquidity out of Open Door. It's wait until these guys find Zillow. It's an actual company. Actually, if you were actually bullish, the AI agent buying, you would buy Rocket, because the AI agent goes on Redfin and it buys, and then it's going to do the mortgage through Rocket. And that whole automation process would be this insane flywheel for them. It's never going to happen, though. No one buys a house without going and seeing it. Are you insane?
Yeah, no, people who are affording to buy a house are not that insane. 2008. Sorry.
Well, but I mean, I bought a house last year, and I wasn't like, oh yeah, let's just buy whatever. That one looks good. No, we went and we looked at a bunch of houses. We walked into them.
Yeah.
You don't go off of pictures. It's just crazy.
You would if you were a dude, single. If you have a wife, there ain't no way.
Really? I feel like even if I was, and well, most people buying are probably be married or at least partners, but I feel like even if I was single, I would go and physically look at the house.
No. Zero chance.
I'd just be like, those pictures are nice. It's got a garage. Does it have okay, it has a kitchen. Okay, yeah, I'll buy. It's got a fridge. It's got a fridge for when I buy my takeout, and I have some leftover. I'll put it in there.
The future is 2030. You're sitting in your chair, morbidly obese, getting fed through the straw, and you're checking out a house. But at the house is an Optimus robot, and it's assuming control for you, and it's just walking around, giving you a life. And you're like, yeah, looks good.
What's that? Wally.
Yeah. Like, oh, gotta have to get rid of this flooring. No. In all seriousness, yeah, I agree with you on that.
Can I say something on that really quick? Because
yes,
on AI and everything,
yes,
it actually makes me super, super excited and bullish for the future. Everyone seems to think it's like a massive net negative when I think it's a massive net positive.
Mhm.
I don't know if for everyone.
Oh yes, we've talked about this.
Yeah, it's like imagine like it's the equivalent of like in the 1800s being like, oh man, electricity is coming, we're fucked. Like, everything's gonna change. We're gonna lose the candle makers and the whale hunters will lose their job to electricity. Everyone's fucked. Or like during the industrial. Like, I don't
Whale
know.
hunters.
It's like, all right.
Hey, sir, have you seen the show Whale Wars? I mean, come on.
No, I haven't, but
stupid Luddites. Yeah.
I mean, Industrial Revolution, same thing. Oh man, all the farmers are losing their job. What's going to happen? But yeah, that's what Luddite is. I didn't know.
But wait, there was another stock that was
cars are coming. Stagecoach companies will wonder. What do we do? What will the horse people do?
What was the thing? There was another stock that I wanted to touch up on. Oh my gosh, it left me. We were talking about Open Door.
Are you okay? Are you heartbroken? It left you.
Yeah, I am.
Is it one that we've talked about a lot or no?
It's one that's being talked about a lot.
By who? Like retail?
I think so. Oh my gosh, Citizen of the Year. Always trying to make the plug. Alti. Fine, we'll talk about Alti. Andrew, you buying Alti? Free income? By the way, I won't say the name of the channel, but I found I love the YouTube algorithm. It fed me a new channel that is probably one of the, if not the most. Oh, we'll talk about Duolingo.
I have a hot take on it, I think, but
this is super quick. Like dorkiest, dumbest person I've seen in a long time, and I love watching this guy because he's really dumb. I might have a problem. The first step to fixing a problem is realizing you have a problem. I think I have a problem. So I don't go on YouTube and watch something informative all the time. I should only do that. Instead, I'll not hate watch. That's a strong word, but like the fast food.
His name's
Yes, I don't even know his name. I just know him by the face, and I'm just like, damn, this guy's really silly. Damn, I don't know his name. But if you showed me a picture, I'd be like, that's the guy. And I thought he was like really young, and then I found he's older than me. I was like, oh my God. I thought because like puberty just like never hit this guy. So no, I'm not even joking. Like he looks like he's 18.
I mean, you could have had a genetic disability, and you're being ableist now. And that's really cool, man.
Yeah, I probably am, but it's okay. He does look like Ryan. Does look like Ryan. All right, but Duolingo. Let me put that in because I'm putting that in the description here, so we're keeping up.
Okay.
What time is it right now? In the stream? 2:47.
2:47. So, don't know much about the debate. Someone said that like Carlson bought it, and then Carlson made a tweet about Jeremy shorting it. I don't watch either of their YouTube channels, so I don't know.
Did you call him Bubbleson?
No.
Oh.
If I did, it was a Freudian slip.
I thought you did. I was like,
No, I've held the opinion like I bubble. Carlson's fine, but
I wish he was the number one YouTuber and not Jeremy.
well,
Or I don't
Jeremy
know if
just
Jeremy's
makes
isn't. No, me, Kevin.
content for he makes content for content's sake. But the short or the hedge that people were saying he did, I mean, clearly that's just a content thing because you don't hedge your portfolio. Like it's not like you have 100% portfolio long, and then you're like, my hedge is a 1% put position on a random stock, and it's like that's not a hedge. But anyways, I don't really care about that. I have a hot take on Duolingo is that Duolingo is a terrible, awful, horrendous platform to learn on.
That's not a hot take. All the language
No,
guys say it.
and that's why it'll be really popular. It's because no one actually cares about learning shit. They just want to feel like they did something. They just want to feel like, oh yeah, I accomplished something. I did the checklist today. I'm learning Spanish. I'm learning Japanese. I'm learning French. I did my little thing, so good for me. And that's why it'll stay popular.
So you're going to buy this stock?
No, because I could be wrong. If I'm wrong, no, because there is a good chance that it also just goes like I'm wrong. But I mean, the average person I feel like is so lazy and so like maybe I have a very negative view of people. I don't know. The average
nihilistic. Yeah.
What? Nihilistic?
Nihilistic.
But it's like I feel like they don't care about actually learning. They care about saying that they are learning something. And like, oh yeah, I have a 30-day streak on Duolingo. I'm learning.
Yeah, and like their ads, everything's to drive the premium growth, and people kind of forget about it. They really want to push you for the annual subscription.
Mm-hmm.
Annual subscriptions have a higher tendency for people to forget about it because it's a one instance. It's a singular instance.
Makes sense.
So it's always better to get them on the annual for two reasons: get the money up front, and they have a higher likelihood of forgetting they have it. When it's monthly, people are reminded monthly that they have it. When it's an annual subscription, you'll get those people that will slip through the cracks, and then they'll forget they have it, and then they'll be like, "Oh, I'm too lazy to dispute it," or they'll dispute it, but past the time where you have it in your terms of service.
Right. If you're really good, you time that annual membership around like February, and people get tax rebates.
Oh yeah.
February, March, April, anywhere in there.
Yeah.
This literally happened to me for CM, but I have to renew. Oh, okay. But what is your take on Duolingo?
Oh man, I don't know much about this business, so I kind of stayed out of the debate. But I heard from all the language people it's a bad platform to actually learn. But in theory, this thing should be printing money, like profitability. They better be very profitable.
No, they don't make money. You kidding me?
What?
I can't say. Look, do you think they make money?
I would be surprised if you told me they don't make money. I'd be very surprised. That this should be like stupidly profitable.
Shouldn't Atlassian?
No, because Atlassian has to spend like buttloads on R&D to keep up with the competition and keep them at bay and figure out new ways to implement. This should be like, I mean, how much more can you change the platform? You add French, you add Spanish, you add next language, and then it's very repetitive between languages, like the process, the system. What are they spending hundreds of millions of dollars on? Getting the little character to go, ha, you did it.
Yeah. Well, you're right. They do have a net income. They are profitable.
Okay, they better be. But how profitable?
252 million in revenue, 44.8 million in net income.
Okay, that's fair. That's
okay.
That's what I would.
I don't know if that's adjusted net income or GAAP, but
yeah, that's more or less what I would expect.
Mm-hmm.
So that's decent margins right there. Okay, so yeah, So if they can grow the subscriber base and people kind of forget about their subscriptions and people just subscribe, like it's kind of like what I say about Netflix. Netflix, I don't really care as an investor if like you are watching Netflix as much as that you're paying for Netflix. Like if you're watching Netflix like a couple times a month, I only care about that in such that we look at probability sets, and the likelihood that you cancel your Netflix subscription if you're watching more frequently is low. And if you're not watching very frequently, it becomes higher. That's the only reason why I care. Otherwise, it doesn't matter to me that if I, for example, for 100% certainty knew that for the next 10 years, you would never unsubscribe from Netflix. And I knew that, let's pretend that that's a scenario, then I don't really care how much Netflix you watch. You're paying, you're doing the thing that I want you to do, which is pay the subscription. The same thing goes with Duolingo, but
their earnings look very overstated. I don't know why their provision for income tax is so low. But
well, they're a greedy, evil corporation that doesn't pay taxes. So
no, the 46 million in income before taxes, and then 1.6 million in income in a provision
is what they owe in taxes. Simon says in the chat, Gap is like 13-ish% net margin. So I'm surprised by that. I thought it would be higher. I was thinking this thing is like 20+%.
Well, they also, of their income, about a third to a fourth of it comes from interest from their cash balance. So
okay, you see, like this is where I'm starting to be like, how? And I'm seeing here they have 830 employees.
Is your question why?
Yeah, like why? Why is this not much more profitable?
I don't know. What's the market cap on this?
15 billion.
So EV of like 14 billion.
Mm-hmm.
It's not a big company, but
if they can keep growing subscribers, they'll grow their way out of all these problems. They'll get more profit.
I legitimately think people don't care to actually learn, and they'll get subscribers who like they subscribe and they go, oh, yeah, like I'm learning Spanish, I'm learning French, I'm learning whatever, and then they'll just forget about it and they don't really care, and like it's not a good product, and maybe over a longer period of time it'll be bad, but for now it's probably good.
A lot of it is a dopamine hit for this product. The design of the app, it's very dopamine hit.
Oh yeah, that's what I'm saying. It's I got my 30-day streak. Oh, the bird's happy.
The bird's happy. Oh no, the bird's mad at me. Yeah. I feel bad. And then all the ads is just like the ads to upgrade.
Mm-hmm.
So they just want you to upgrade. And oh my God, they have loot boxes. I forgot.
Oh, it's like a gotcha?
Yeah, they have a loot box system in there.
Can you get a Labubu in the loot box?
No. It's not physical things. It's all digital.
Oh. You have digital Labubu.
Digital poo-poo. Not capital. I'm reading his whole message. Fuhat says, why can't just use AI to learn this? That's massive bear case. I had to read it like that because it's all caps.
Good question. I like how, I'm not going to say who, someone said that the skill guy. Yeah. I was laughing when he said the gap between his ability to actually research and do some work on companies and communicate them is so vast.
Yes, it is.
Yeah. So.
Okay, I guess we covered all our topics. We're at the 3-hour mark. We can talk about what are we doing, Andrew? What's the thing on the horizon that we?
If we were going to talk about this, why do we wait for 3 hours in?
Well, actually, we have way more viewers than when we first started.
Okay. Yeah, they're probably half of them are asleep. Probably half of them are just asleep at the computer.
Okay, then what we can do is take advantage of that and whisper things into their ears and affect them when they wake up. So now when they wake up, they're going to do something that, they'll think is their idea, but it was really us putting it into them.
Okay, so we're gonna get to that really quickly though. I didn't. Mr. Seymour Duck is saying a fake Labubu is called a Lafufu, and if that's true, that's actually really funny.
No way. I'm not. Wow. That's
Okay. So what have we been doing? We have been working very hard behind the scenes, and we should do. I mean, we should do dedicated streams where it's like important announcement. But this can be a stream, and it's not the official announcement. But we'll do more streams and talk about this. But we have started our own investment fund, hedge fund, I guess you could call it. I always feel like we're starting a hedge fund. When I'm like, yeah, it's an investment fund, but like, yeah, I guess the word that people use is hedge fund. So we're doing that. We're looking to start October. The realistic time is probably November, but we'll see. So it may change the way that we can talk about some positions or talk about stocks, but for the most part, stuff will continue. But for real, it's like the most exciting thing that Fabio or I, have been working on as part of this whole investment journey, at least for me. So we're currently in we are still raising funds for it. So if anyone out there is interested, you can reach out to us to learn more, to discuss if you want to become an LP, things like that.
well, the restrictions. They have to be an accredited investor.
Oh yeah.
Should we say what the minimum is?
Right now, the minimum is 200,000.
Yeah.
And you have to be an accredited investor. You can look up what that means, but I'll tell you, million in net worth, not including your primary residence, or you make 200,000 a year if you're single, or 300,000 if you're married,
or Series 65 license.
Yes. So that's what we've been working on, and down the line, hopefully, we'll have more. I guess you could say offerings, but for now, that's what it is. So yeah, 200,000 is an investment. Like I said, if you want more information, you can reach out to us. I guess you could either message us on Twitter or X. If you're in the Discord, the Capital Mindset community, or on Discord, you can reach out to us there. But yeah, I mean, for us, it's super exciting. I just want it to open up. I mean, I'm just like, I want the whole market. I'm just like, whole market crashes. I want it to go to zero. But it's exciting. I don't know. Anything else?
No, I mean that's basically it. Like we'll have more details as we kind of go along. We've already given more details to the CM members, as far as like, well, what we just provided basically. We're going to be starting fundraising here in the next month or so, and I mean I'm already having meetings with investors, mostly from outside CM is the ones I've been having meetings with.
Yeah.
So.
Yeah, I mean, I've had a couple. I know.
Someone's asking, has anyone ever done the Series 65 exam? Well, Andrew?
Yeah. For me, it wasn't that difficult. It was the only thing annoying about it, because I believe the 65 is one that has the blue sky laws. Sometimes remembering which state says what, I think, is in the 65. But to me, it wasn't a super difficult exam. I think you can probably study, if you just sit down and study it, probably, I think I did it in like 2 to 3 weeks tops.
I think it costs like $185 to do the exam. Study materials could cost anywhere from $200 to $400. But yeah.
I mean, here, like online, it says 50 to 100 hours, 6 to 8 weeks. I think I did it in like 2 to 3, but I was also doing it full time at the time. I was getting paid to study, so it makes sense.
Yeah. Yeah, and so we'll probably do like a public live stream on it in the future. Really, like we're like I said, I'm at the phase where I'm going to some places, having dinners with investors, and right now it's all been outside of CM though.
No, we're not calling the fund Fabio's PP. That is, we are not Meet Kevin. We are not doing that. Yeah. There is a lockup period of 1 year. I mean, we can go if you want to reach out to us this in the year, like more than happy to talk to you. I think you have us on Discord.
Yeah.
Just feel free to reach out and we can go into all that stuff. We have it all built out, like what we're going to do on that. It's just you know, don't want to. We're already at 3 hours and 2 minutes. We will continue to talk about it and go more in detail publicly, but feel free to reach out to us. You'll probably reach out to. I think you know Fabio better than me, so probably. But yeah.
Okay, so there's some good there's one good question about drug companies, but we're past the 3 hour mark. I'll try to do another live stream this week. And sorry, Kiwi Sam. Okay, I have to. He did like two times a very unsanitary message.
We're trying to be professional. No more fun.
Okay, so that is something I will warn all viewers. So Sam, I know you're still listening. We'll probably have to be more moderaty than we used to be. So just a fair warning.
I don't know. We're not in charge of what people say. I mean, yeah, we might have to remove some comments.
That's what I'm saying. We'll have to remove some comments, and like you can't talk about a bodily fluid and type it out in the chat. But you know, I know you enjoyed doing that before a lot. So that's something we'll have to refrain. I didn't ban you. It says that he was banned. Did I accidentally ban him? I thought I put him in timeout. Because the reason why I did it the timeout, he was saying, was it deletes all your messages.
I don't even know. Oh, maybe that's on the YouTube end that you have to do that. I don't know. I can't.
Yeah, he shouldn't be banned. I think I just put him in timeout. I don't even know how much this thing puts you in timeout for. But yeah. Other than that, that's about it. 3 hours. Enjoyed it. You guys have any? Oh, okay, still rating. No, Fuhat. You can do stuff like that. We're not going to be like insane about it. You just can't say what he said, which I won't say verbally because it's a bit. You can't describe gross bodily fluids.
Who said they're gross?
Whoa. Okay.
On that note,
yeah, like comments like this are fine. We're not going to be crazy, but yeah, you see, okay, fake alias is like, yeah, that's reasonable. All right. With that being said, thank you guys so much for joining us tonight. We'll be seeing you guys. I hope to do another live stream this week. No promises. But for sure, if you're in capital mindset, you're going to get your weekly ICOM this week because we got some stuff to talk about. And I'll probably try to do the weekly call either tomorrow or wait, no, I think I have something on tomorrow. So Wednesday. And then other than that, if you're not part of the Capital Mindset community and you're looking to be part of the Capital Mindset community, you can check out the description below. That is our sponsor for today. And we'll see you guys on the...
Okay. We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.